Ahora sí.
Thế đâu đối là có đầu gì đấy luôn.
Bruce, can you now hear me? Bruce, confirm if you can hear me.
Yes, I can hear you. I'm okay now.
Okay, it is now working.
Yes, it's working, yeah.
Okay, thank you. And the class attendees, good afternoon once again. Mine, you are just hearing Felicia Vageneza, working with ECPA, the principal examiner. It's a pleasure to be with you in this session. And on behalf of ECPA, I just welcome you to this session. So we'll be together with Bruce. Of course, we have time to present himself. And he will be our moderator for today's session. There will be another session scheduled next week. So I hope you will join the session. So actually we planned the 2 sessions for this I-12 financial reporting division class. Just the intention of this class is to update you on the current issue and the most hints and tips for examination. And the moderator will try to take you through the most critical issue and most important issues as far as this November examination is concerned. And of course, you will participate by using chat box or using Q&A chat box. There is a way you can to use voice. And then I want to request you to avoid disturbance. Make sure that your microphone is muted such that you don't disturb our presenter. And again, I'm now going to welcome Bruce to start his presentation. And this session will take like 4 hours it is from now up to 5 p.m. So Bruce, you are most welcome. Now the floor is yours and the mic is yours.
Thank you, Felician. And just to say good afternoon to you all. I'm hoping you're all doing well. I understand the pressures you may be having in respect of the fact that your exams are just around the corner. But those pressures should actually be pressures that should go away, especially if you go by the tips that we are going to share today. Of course, the other bit is not only to listen in, but also to take home what you're learning today and how to approach your exams in light of your exam preparation in the next few days or few weeks to come. This is such a paper that is practical, that you don't only rely on reading or rely on listening to a lecturer, but also you need to actually practice. And by the time that we are done today, or even the second session where we shall actually meet the second time, I think the song we shall both be singing or all sing will be to practice, practice, and practice, because it's until you practice that such a paper like I-12, you'll be comfortable and confident to sit that exam. I'll tell you that it's a paper that is not bad to pass. It's a paper that will have good pass rates if you actually go by the tips. I know most of you or all of you are attending or have attended lectures from lecturers who are competent enough to actually prepare you for the exam. So today's session is simply to complement and add on what your lecturers or tuition providers are actually supporting you with. Please take advantage of all those provisions of lecturing or tuition support that you've received, including ICPAL's organized workshop, because this is further to aid or to give you that confidence that you're good for the exam. Like you've heard from Felician, I'm called Bruce Ntege. I'll later write the name just in case some of you have not picked the name. And I'll also give you my email address and the contact. I support in this, I'm a CPA, so I'm a CPA as well. And I also support in providing lectures in such professions like CPA, RANDA, And I also work with a certified tuition provider in Rwanda. So I'm a certified trainer with the ICPAL, just like I also work for a tuition provider called Inest Academy, which is also a certified tuition provider in the country. I've been in Rwanda physically teaching through different institutions. There's a time that I taught through CBS, College for Business Studies, and the most recent was teaching through Cornerstone, which is actually also providing the same course. But currently I'm actually tutoring with Inest Academy, and this is one of the papers that I actually tutor. I'll be using my screen, which I'll share in a short while, to actually go through and talk you through the guide that we are having today. But I'll also be practical to ensure that as we go through the different topics, we're able to relate it to a past paper exam and actually showing you exactly how would go about it in terms of the approach, but also looking or taking you through what are the shortfalls or pitfalls that students have had in the past in those topics. It's my understanding that by me taking you through the approach on how to answer such a question, and also taking you through the pitfalls that students have suffered in the past, you should be able to pick lessons from that. And those lessons should be able to help you prepare well for your forthcoming exam. And to be honest, me and you should agree by the end of our 2 sessions, you should be just ready to say, when is this paper? And I am actually one of the guaranteed students that should pass. That is my objective, and hopefully that is your objective as well in this session. So I'm going to share my screen at this moment, and then I'll move on to my talking points that are going to guide us in this process and be able to help us walk through. So I'm using slides now, but I'm going to go into what I'll call summaries, which is going to summarize your topics, especially the accounting standards and also the public sector, the IFRSs and the public sector side. So I'll tell you that your paper, I12, has 2 sessions, which you certainly by now should know. You have section A and section B. Section A has 3 compulsory questions. One of them, in most cases, is going to be on published accounts, either for a single company or for group accounts. But this will be complemented with other areas that are examinable, including other areas that make up the other 2 questions. It's not a must that all the 3 questions must have published accounts, but any one of them can have published accounts. Now, in total, section A with 3 questions will have 80 marks. 2 of those questions usually will have 30 marks, and 1 of the questions will have 20 marks. In total, those are 80 marks, and all these 80 marks are compulsory because these 3 questions are compulsory. Now, section B will have 2 questions, but you attempt any one. Each of those 2 questions will actually have 20 marks. And this section B will cover any other area of your FRS syllabus that has not been examined in section A, or can even complement some of the topics or some of the areas that have been examined in section A. So you don't rule out any. So in other words, don't spot. Don't say that because I'm aware or I've seen most past paper questions, I've set questions mainly on this accounting standard or this topic. So I'm focusing my reading only on that topic. Please, this paper examines the entire syllabus, and any topic of that syllabus can be covered anywhere in this particular paper. So therefore, as a student preparing to sit this exam, you must assess yourself between now and exam date. You must assess and test your ability to appraise or to evaluate or to assess or even critically discuss and apply the accounting concepts and principles that you are being lectured into or that are covered in your syllabus. So have that grip to say, yes, I'm comfortable in terms of at least as many as 90% of the topics and the IFRSs that are basically covered in this particular paper, especially if this actually comes through those small scenarios. The beauty with this paper is that you don't have very overarching or very large scenarios. They will be snapshot, very short, but you need to be able to make out which accounting principle is in that scenario and how do I link that or align that to the question that's being examined. So I'll tell you that if some of those scenarios require you to have apply them in the question, then mere knowledge of the accounting standard or principle will not be sufficient until you apply it to the information in the scenario. Please don't go in the exam and just copy and paste what you've learned or read in a way of a rote learning approach. You basically need to be practical with the information that is given to you in the scenario and relate that information to the question and the answer you are displaying. Otherwise, when it comes to public sector entities, which I'll be handling in the second session, which I'll be meeting, I want you to be aware that yes, we have a different accounting version for the public sector entities compared to the accounting concepts for private companies. So whereas we use IFRSs or IASs for the private companies, when it comes to public sector entities, we shall actually be using the International Public Sector Accounting Standards, the IPSAS. But those IPSAS are blended or are built on the IFRSs, but trimmed or aligned or revised to suit the public sector environment or accounting environment. That's the beauty. Of course, there are other public sector standards, IPSAS, that have no equivalent of an IFRS. That is because public sector entities may have certain aspects that have nothing to do with the private entities. So in that case, and those are not many, there are few, but those are cases where maybe you may not have an equivalent IFRSs. But please, on a general note, please note that IPSAS are built on the existing IFRSs, but blended or revised or adjusted to suit the public sector accounting environment. So in your exam, therefore, I'll tell you that where possible and where applicable, you structure and you present your answer in a way that should assist the marking process. Therefore, the person who's marking your script should find it easy. There's a tendency, and I want to tell you that there's a habit in us Africans, overwriting. That is not good, especially the marker who has already spotted the point. If I have already spotted the point, and that's the point I'm looking for, if you actually write 10 other points that are similar, the person marking your script will only go by the point that you first gave, which is valid. Secondly, there's a case where you actually congest your answer with actually too much information, some of which is not relevant. So in that particular case, again, the person marking your script is going to look into that congested answer. Maybe you have written 10 lines, and those 10 lines are making 1 point. Is going to look out for what in those 10 lines makes up the point. And you're making a lot of trouble for yourself because the person is looking out for the point. Of course, ICPAL marking scheme and marking process is very articulate. Even while you write too much, the person marking your script is patient to read out for the information or the statement that makes a point. Yes, that's okay. But again, there's a point where you may actually mix up so many things and you're actually confusing your marker. So I would therefore suggest, as you go through and you'll see me while I'm actually making my statements, I'll suggest that for every fresh point you're making, start on a new line. If this is a narrative, like assuming that you're dealing with a question on ratio analysis and you're making your analysis or your interpretation or explanation of the ratios, for every new point you're making, start on a new line so that you don't congest, you don't mix them up, and you actually make the marking process quite complicated. And which, of course, as much as the ICPAL markers are very keen to ensure that every statement is read, you never want to actually rule out any human issue that may emerge. Otherwise, if the question has more than one part, maybe part A, part B, part C, ensure you've answered all the parts of that question before you leave that question. Otherwise, you've not actually attained all the marks, and you want to put yourself in a comfort position where you are confidently getting out of the exam room knowing that you've actually answered the paper and you are standing a better chance of passing the paper. I want to tell you that one, a person who has answered all questions stands a high chance of passing the paper. Secondly, a person who has finished the paper stands a better chance of passing that paper. In other words, finishing the entire exam paper will give you a good chance of passing the exam. Now, between now and exam date, it's important to actually check your understanding of the accounting principles, the topics, which are actually going to be part of the exam question, so that when you go to the exam question, you are not just repeating or reciting those principles, but you're actually relating them to the information that has actually been given to ensure that you are actually giving the right answer. So 3 things that are very important as part of your exam tips. One is that in the information or in the question, in the scenario, ensure that you read the information in there and ensure that you are able to summarize the facts that are in the scenario to ensure that that helps you or guide you in how you are addressing your answer. Secondly, even when you're starting your answer, think loudly, think aloud. So think loudly such that you are able to come or craft an answer plan that helps you actually draft the question and that, answer the question. And that response should be in respect of the requirement of the examiner. Otherwise, without a good plan or without planning, applying process that is sufficient, you may not be able to convey the skills of comprehension because you need to comprehend the information in the scenario with the requirement, and then you are able to craft your answer in there. You will not also be able to have the skills of application or analysis, which your examiner is expecting of you. Some questions are not only computational, but they require you to explain or to discuss. Then after having done your planning of the answer and including how you are going to go about the answering, then start writing the answer, but write it in the style that is able to address the examiner's requirement. And write to answer that question as directly as possible as you can. Then actually starting to go around the question and crafting your own question. There are cases where students develop their own questions because that's what he or she would want to have seen, or that's what he or she crammed to come to exam with. And therefore, you are developing your own question away from the examiner's questions. Please, I want to tell you that in all the ICPAL exams, and specifically this paper, the questions shall remain original. As much as you're going to rely on the past paper exams, don't necessarily expect the examiner to examine and to develop the question and the scenario in the very way the past paper question has been. So the examiner's questions are always going to remain original. So if you went to the exam with this mindset that the question must be exactly what I saw in the past paper or what my lecturer was revising on a particular day, and the question is different, then you start going around it to craft your own question the way you want it. I can assure you, you will not be answering the examiner's question, which examiner's question is always original. All that is needed from you is the understanding of the accounting principles coming from your topics to address that original question in the way the examiner has examined it. While you're doing that, it's important to manage your time in the exam, and time management is very important because most students will not finish because of poor management of time. But again, the moment you don't finish that paper, you are starting to reduce your chances of passing the exam. So allocate your time between the requirements using the marks. So for example, if I know that this paper, remember that your exam paper in total, let's just look at one of them. Anyway, I know that in total your paper has 3 hours and 15 minutes. 15 minutes are to plan, reading through the content and planning. So technically take 3 hours. And you are actually answering questions that total up to a maximum of 100%. So what does that mean? If you're using 3 hours are equivalent to 180 minutes. Each hour is 60 minutes. 3 hours is 180 minutes. And you're trying to earn 100% in 180 minutes. Then it means that every 1 minute, every 1 mark is 180 minutes for 100 marks. It means that every 1 mark is earned in 1.8 minutes. Let me repeat this. 180 minutes to write for 100%. So every 1 mark you're earning, you are writing it or earning it in 1.8 minutes of the exam. If the question you have is 10 marks, if that part of the question you're working is 10 marks, and yet for every 1 mark is 1.8 minutes, then 10 marks are going to be earned in 18 minutes. So therefore, if I have a part of a question in front of me which says 10 marks, then I should actually concentrate and therefore ensure that I allocate 18 minutes to that question, and strictly 18 minutes to that question. The 18 minutes include reading the part of the scenario that answers that question, include planning the answer or approach for that question, include writing that question, If possible, if that's your practice, it also includes reviewing what you've written. 18 minutes for 10 marks. Please stick to that. I'm giving you that as an example. The moment you've written your, the moment you've finished your 18 minutes, please move on to another question, even if you've not finished this. In other words, stick to that time you've allocated to that part of the question and move on. History or experience has it that the time you spend, sorry, the first minutes of any question you are attempting, you're so fresh on that question, such that the earning capacity, the earning of the marks, your capacity to earn marks is very high in the first minutes when you're attempting that question than in the last minutes. So what am I saying? If I have this question that had 18 minutes, and after 18 minutes, I start negotiating with myself to say, let me extend by 5 more minutes because I've not finished it. Those 5 minutes you're extending is the later part of your time on that question. You are earning low. Your capacity to think is actually low. And your earning of the marks is low. In any case, you're even starting to think and debate with yourself that I've extended 5 minutes. Where am I going to get them from in another question? You're different from a student who left that question immediately and went to another question. And in another question, that student is now very fresh in those 5 minutes to start earning marks quickly in another question. So at the end of those 5 minutes, if these are two students, one student, the best that student has earned is 1 or 2 marks, while the other student is earning around 4 or 5 marks in those 5 minutes. So that's the reason why you may, or students would get a 48 or 45% or 49% because they didn't finish that paper. And that person was not strategic in time management to quickly move to another question the moment he or she was done with the 10 minutes allocated. I'm using 10 minutes as an example, but with the time allocated to this question part. So stick to that time. Please, in the exam, make it become part of your habit that I stick to the time I've allocated to that question. Otherwise, for you to actually be able to do that, you can't wait for the live exam day, that final exam day, to say that is when I will practice time management. Start now. You have the chance of having past paper exams on the ICPAL website. Can you download them? Can you test yourself in terms of time management? Of course, also the strength of content, how much and what are you writing? But can you also test your skill on time management and check how you are good at time management? Now, I'll tell you again from experience, if I have this one particular paper that I'm testing myself on time management, and I'm going to use that paper throughout until the exam date, I'll tell you that the first time I'll attempt myself, I'll test myself, I'll be very poor on time management. A question that takes me 10 minutes or 18 minutes, I may do it in double that time, 36 minutes. The second time, I'll actually be better than 36 minutes. It will go down to 30 or even less than 30. The third time, it will actually go down to the 18 minutes, or the fourth time to the 18 minutes I need. The fifth time is when you're in the exam. Now you are very good on time management. Please, and I want to repeat this, please don't wait for the exam date to start managing time or start practicing how to keep time. Start now after today's session if you've not done it before. So I want to go quickly to the summaries of the different topics you have and also use those summaries to link them to the actual questions in the past that have come. And we actually go for the two things. One, the question approach and the bad things students have done generally on that question to make that student or those students not pass well that question, which is not what we want you to repeat. Remember that the examiner and the marking team is going to still examine and mark you in this setting, and more likely the same problems and challenges students in the past suffered and caused them not to pass exams will be the same again. You don't want to be part of that big same. You want to be part of the special pass. So I want to move on to the summaries I have, and then at that point we are going to look at practical questions for each of some of the topics that I'm picking as key topics. Now, please, these summaries are built on the content you already have, either from the study materials that you are able to access, some of which are coming from ICPAL, or from your lecturer notes, the notes you get from your lecturers, or from other publications that you have. So what I've done is to summarize them in the context of your syllabus in this paper, I-12. So starting with the topic called conceptual framework, which is a very key topic in this paper, I'll tell you that you must at this point check. And I'm using this, if I'm you, I would be using this as a checklist to say, am I good at that? Do I have the knowledge on that? I'll tell you that one of the key important issues in the conceptual framework is understanding the objective of financial statements, especially general purpose financial statements. And the objective of the general purpose financial statements is to provide that financial information that is useful to the primary users. Usually primary users of the financial statements are the providers of capital, either equity capital or debt capital. And this is to help them make decisions of whether to invest by buying more shares, or to de-invest by selling those shares, or to invest by giving a loan to the company, or to recall that loan. Of course, the secondary users of the financial statements are other people who are not directly providing capital, people like the employees, people like the suppliers, especially suppliers who are not providing on credit, because those providing on credit are actually providers of capital, or people like the government regulators who are actually looking at financial statements of a company to assess resource mobilization or resource allocation in the country, and also to assess the amount of tax revenue that will actually be earned. So those are secondary. But primary capital providers are those that we are looking at in this case. So check yourself, am I good at that knowledge? Of course, that knowledge we may want to check with how that has been examined before. Otherwise, remember that in the conceptual framework is where we say that financial statements, while they are being presented, there's always that underlying assumption that goes with the financial statements, and that does not have to be disclosed explicitly. We don't have to have it written that financial statements are prepared on a going concern. No, they don't have to write that, except if the company's going concern is questionable, and therefore there's that uncertainty. That is when that uncertainty is disclosed adequately. Or if the company is closing, then that's when we shall even change from presenting the financial statements on a going concern principle to maybe a breakup principle. Otherwise, if you remember again, within the conceptual framework, we're even taught that those sets of financial statements, which actually give the financial information to the readers who need to make decisions, must have characteristics that make that information very useful to help the person making decisions make actually a right decision. And those characteristics will actually be what we call the qualitative characteristics. Some of those are fundamental, that any set of financial information must fundamentally have information that's relevant and information that is based on faithful representation. Otherwise, some of those are actually going to complement and therefore enhance the two fundamental principles to ensure that that information should be comparable. If this information is about 2022, then we should have a comparative year, which is 2021, to ensure that that information is therefore relevant and the decision maker can compare one year against the other year to make a decision that is based on the relevant information. So comparability will support that relevance in a way. Otherwise, that information should be verifiable, supported by the economic phenomena or the transactions that have actually taken place. So that the figures you present on the financial statements have a background, have a foundation, and they can be verified. They can have support documentation, and that verifiability can therefore ensure that faithful representation is well manifested in the financial statements. So verifiability will actually enhance that concept called faithful representation. And that information should be provided on a timely basis. Meaning that if today is 2022, you should not be providing me financial statements. If I'm the user who wants to make decisions, it's not today in 2022 that you are providing me information of 1990. That is not relevant anymore because it's not timely, it's outdated. So today you should be providing me information of the most recent transactions. So timeliness will actually support relevance. So that information will be relevant if it's provided to me on a timely basis. Otherwise, that information should be clear, should be well classified, should be well presented, and should be actually put in the right place. For example, in the right statement, like the profit or loss, or statement of financial position, or statement of changes in equity, and supported with details that explain it, especially if figures are actually going to be accumulated on the face of the financial statements, to ensure that I understand that information that you've actually given me. And that understandability is not only looking for me, is not only supporting me with relevant information, but it's also helping me to support or to have the confidence that the information you've given me is faithfully represented. So understandability supports both relevance and faithful representation. Otherwise, all information of figures of financial statement transactions and balances that are presented in the financial statements shall fall under any one of these 5 categories. Either they are assets, so that information or transaction could be an asset, or it could be a liability, or could be equity, or an item of income, or it could be expense. So Those are the elements that make up the financial statements, or the categories of blocks or building blocks that make up our financial statements. And it's the conceptual framework that will help define those 5 elements and also help determine the recognition criteria for those financial statements, so the elements to get to the financial statements, and also the measurement of those 5 elements. Meaning the recognition, which is the process of capturing those elements into the financial statements, is actually going to be driven by the general recognition criteria coming from the conceptual framework. Please note that in the revised conceptual framework, the recognition criteria of those 5 elements is going to be pioneered or supported by the 2 fundamental characteristics, the relevance and the faithful representation, to say that you're recognizing this asset or liability or income or expense or equity in the financial statements, because by you recognizing and capturing that information in the financial statements, that information is going to be relevant and faithfully representative to help the user make a very correct decision. So otherwise, again, it's the conceptual framework that gives us the measurement basis against which we shall attach a monetary value of that element in the financial statements. So there's nothing you recognize. By the way, remember, recognition is the double entry, debit and credit. Again, the thing I need to ask and actually check with you on your own, of course, you can do this as a self-assessment, is am I good in ensuring debit and credit? Do I know when to credit and when to debit and what to debit and what to credit? That's what we call recognition. You're recognizing something in the financial statements. But when you're debiting or crediting, you have a monetary value to attach, which is the measurement. So the conceptual framework says every transaction you're recognizing in the financial statements must have a monetary value, and that monetary value will be based on any one of these 4 measurement bases. And those 4 measurement bases are coming from 2 categories of measurement concepts, either historical measurement concept, or it's going to be based on the current value measurement concept. Usually we know historical cost measurement concept is the most general and the most common one. In any case, it's the one that helps with ensuring faithful representation, because it's verifiable on the basis that I bought this building 10 years ago at 100 million, and there was that documentation, which included the contract, which included the receipt, which included so much. So historical cost, you only adjust it with maybe depreciation. Otherwise, in some cases, companies can change that historical cost to what we call the current value. You move away from what you did or when you bought the asset 10 years ago to come to the current value of that asset, either going by the current cost, that how much does it cost me to buy the same building today, 10 years later, or by going to what we call the value in use, to say, if I have the building and I intend to use the building for 5 more years, what's the value in use of this building, by looking at what I expect to earn from the building, discounted to present value, using an appropriate discount rate. Or I can actually go by what we call fair value, that if I was to sell the building rather than actually looking at buying the building is the cost, current cost method. But what if I'm to sell the building? Then in that case, what's the fair value of this building based on how the market would willingly take the building? So that's why we have a standard called IFRS 13. So IFRS 13 looks at that fair value measurement based on the price to sell the building, not the price to buy the building. So it's the exit price, to say if this building was to be sold off, this would be the selling price. But that selling price is based on the market specific price, not your own interested price. So if I'm ABC Limited and I have a building and I'm saying I want to determine its fair value, I'll not go by the fair value of what I would want it to look like, which would be the interest specific value, but I would go by the price that the market out there with active market participants would usually buy a similar building, especially if this is a non-financial asset, would even look at what's the highest and best use of such an asset out there in respect of that. And that's why when we look at using the fair value concept, in accordance with IFRS 13, then we would want to limit that subjectivity that I would want to put in by ensuring that I maximize the observable inputs and minimize those non-observable inputs. Non-observable inputs is why we come up with our own assumptions. Observable is that in the market, we can clearly see that there's a market for buildings of the type I have. And in that case, that market usually uses the building as a school, not as a hotel the way I use it. And in that building, in that school market, in that market for school buildings, this is how they usually sell the school buildings. So in that case, I'm maximizing those observable inputs and minimizing any non-observable inputs. So please remember then that as you get ready for your exam, how good are you with the topic called conceptual framework? Specifically, or in there, how good are you with even IFRS 13, fair value measurement? Because one of the 4 measurement bases that the conceptual framework says you shall always use to have a monetary value to that entry you're saying debit or credit. Now, otherwise, we have the accounting policies, which are actually going to be guided by IAS 8. Again, just double check with yourself in terms of your knowledge with this accounting standard IAS 8, which does not only limit you to accounting policies, but even looking at changing those accounting policies, which change in accounting policies is not normal. I'll tell you that it's not everyday thing that companies change accounting policies. Accounting policies is what you see in organizations as finance manuals or finance policy documents. They don't have to be changing them every day, except where it's actually relevant to change them, or except where there's a requirement that change that policy because an accounting standard has changed. But what changes every day, or what can change more regularly, is the accounting estimates, because estimates are built on assumptions. Then those assumptions, if they change or factors change, then that can actually result into a change in a figure called an estimate. Or errors. Errors are not every day, but where there are errors that have been identified, you need to correct them. You don't have to go and actually continue to have financial statements with errors. So in this topic that you must have done and you're ready to sit and examine with IAS 8, you must be very clear in when do we change accounting policies, because it's not every day. Otherwise, in principle, changes in accounting policies are not changes in accounting estimates, and never confuse those two, as much as at times they can actually be a little bit confusing to distinguish or to separate. For example, I'll tell you that if you're changing from having or measuring or carrying a PPE from cost model to revaluation model, you are changing your policy. You've changed from using cost model to a revaluation model. But if you're changing a depreciation rate, if you used to depreciate over 10 years and therefore 10% to now 20 years, which is 5%, you're changing an estimate. And that estimate is based on the estimated useful life, which you've changed from 10 years or 10% to 20 years, which is 5%. Otherwise, changes in accounting estimates and also in principle not corrections of errors. So if last year you used to depreciate based on 10 years, and that was based on the information you had, you thought this asset would only be for 10 years. Let me change it around. If last year you used to depreciate based on 10 years, and now you're depreciating based on 5 years, and the reason why you're changing to 5 years is because there's a new technology that has come that outdates that machine. And that's why you can only now have it short-lived to 5 years. It's not because last year you were in error. It's not that last year you did it in error to have depreciated over 10 years. Last year, there wasn't a new technology. That new technology has only come this year. And that's why, therefore, we shall have a change in accounting estimate accounted for in the year of the change and prospectively in future, if that change impacts on the future, but not backwards in the past. So we never apply retrospective treatment to changes in accounting estimates the way we do if it's a change in an accounting policy. So accounting policies are not regular. Changes in accounting policies are not regular. They are not common. They can only arise when 2 things happen. Either when there's a new standard that mandates that you must change your accounting standard or policy. For example, the moment we had a new standard called IFRS 16. IFRS 16 is on leases. And that standard started with effect from 1st January 2019. Then in that case, all companies that were lessees or leasing assets had to change from the old standard to now IFRS 16, and there were significant changes in the accounting records. And that was because there was a change that was mandated by virtue of the fact that there was a new accounting standard. Or there could be a revision within an accounting standard that requires you to actually change to go by the new standard or the new revision in the standard. Otherwise, there's an option window where companies can change the accounting policies where they do it voluntarily. Because in the interest of the users of the financial statements, if they change this accounting policy voluntarily, the information that will be presented will be more faithfully representative, in other words, more reliable and more relevant to help that user make a better decision. So that is changing the accounting policy voluntarily. When we have a change in an accounting policy voluntarily, you must apply what we call the retrospective treatment. So go back in the past to the earliest year presented and change that accounting, change the figures there in respect of the change in accounting policy by restating through what we call prior year adjustment, as if the change in policy took place in that prior year. In your exam, usually just go back 1 year and restate the brought forward item in the asset or liability and the equivalent or the related item in equity, usually the retained earnings line. You restate the brought forward because of that change in accounting policy voluntarily, which has required you to apply the retrospective treatment and commit yourself to a prior year adjustment, except where that is not practically possible for you to go back and demand and identify or compute the figure that would have been had you actually applied the accounting policy in the prior year. Please, those cases are very rare. In your examiner will always require you to do a prior adjustment where it's assumed that it will be practically possible to do that, especially when the examiner gives you the information that helps you make that prior adjustments. Remember, changes in accounting estimates, never do a retrospective treatment, always go by the prospective treatment. Or even mandatory changes in accounting policy because of a change in an accounting standard, there is usually what we call transitional provisions within the new standard or the revision of the standard that allows you to transit from the accounting, the old figure to the new, from the old approach to the new policy or the new approach. Now, the correction of prior period errors is so similar to the change in accounting policy. You also account for it retrospectively. So that error is an error that was made in the prior year. Either you omitted and missed it, which is a big omission, a material omission, or you misstated. In other words, you made an error, and that error was actually a material misstatement. Now that you've known it this year, you didn't know it last year. So yes, last year you continued to actually present and publish your accounts with that error in there. Now that you've known it this year, you don't continue to have those brought forward figures based on last year's error, continue to be the same. So you go back and restate those opening balances, especially whether it's a relevant asset or liability line and the related item in equity, normally the retained earnings line. So therefore, retrospective treatment means that you adjust the opening balances, including the relevant item in equity, which is usually the retained earnings. And you restate the comparative figure in the balance sheet, either the related line in the balance sheet asset or balance sheet liability. So again, just check by yourself, are you clear and good with IAS 8, which is accounting policies, changes in estimates and errors, especially considering that that standard has those 3 areas to consider. One is the accounting policies, but rarely, yet it's important, you may have to change the accounting policy if there's a new standard mandating you to change, or if you're doing it voluntarily. Otherwise, normally we shall change accounting estimates, and therefore normally we shall always have prospective accounting treatment. Otherwise, am I also clear as a student before the exam in how to deal with the prior period errors that need to be adjusted? Okay. Or somebody is asking me IFRS 13. Okay, so let me recap on IFRS 13 before I go to IFRS 15. So IFRS 13 is fair value measurement. Now, fair value measurement is actually, this standard is actually the global standard that deals with all those transactions or all aspects where you are saying that this is measured at fair value or this is carried at fair value, except those standards that are very clear with their fair value, like IAS 2. IAS 2 is inventories. IAS 2 says that at each reporting date, can you assess that the inventory is not carried or is carried at an amount that is lower, that is based on the lower of cost, or what people call carrying amount, and the net realizable value. So that concept of or ever fair value, less cost to sell, what people call net realizable value, in IAS 2 already takes into consideration fair value principles there. So you don't have to say in accordance with IFRS 13, but all other standards which say in terms of fair value, you go to actually IFRS 13. So fair value, IFRS 13 is the global standard that guides on fair value measurement for both assets and liabilities that need to be carried and measured at fair value. Only that when you're looking at these assets or liabilities, you need to structure them. Are they financial in nature or non-financial? How do you structure that? Either the examiner will tell you that this is a financial asset or this is a non-financial asset. Please, financial assets can also extend. Don't quote me wrongly here. Financial assets are normally in a standard called IFRS 9, but we can have another case of a financial asset which is a lease. and a right of use asset, especially the lease liability. By its nature, it's also a financial item or a financial instrument, but it has its own standard, which is IFRS 16, not IFRS 9. Now, to the extent that this instrument or this item is a financial item, then we shall go by those principles of fair valuing them in respect of those other standards. But if this is a non-financial item like PPE, a building is a non-financial item. Why is it non-financial? Its value can change. If today I went to this company and found that the building, or to this city and found that the building is of high value because the community actually regards it very highly, and it's 100 million, it's very possible tomorrow I'll go and the community has actually changed its perception on that building and the value has gone down. Or it could even be going down naturally because of depreciation, not only impairment losses. So because of that, the value of a building is never static, it's never fixed. So it actually keeps changing because of impairment losses, because of depreciation. So because of that, it's a non-financial item. So everyone I'm carrying that non-financial item based on fair value. IFRS 13 says that we shall have it based on its highest and best use, not necessarily how you use it. Secondly, we shall also have it based on the market price for the fair value, not your own interested price as an entity. So it's not driven by the entity-specific price, but it's actually driven by the market-specific price. When that happens, then in that particular case, we shall actually have the fair value of this item taken in the financial statements, driven by the market perception, not driven by the company itself. And then the different IFRSs will have to pick it from there to say either I'll be doing the fair valuation every year. If, for example, it's IFRS 9 and financial instruments carried at fair value through P&L or through other comprehensive income have to be fair valued every year. Or you come to IAS 16 PPE and for it to say that fair value is driven by the revaluation model, which is done regularly, and it will depend, the time factor will depend on the company's interest and profitability. It can be every year or every 2 years or every 5 years. But then IFRS 13 first gave you the litmus test. That is where you determine, or you are guided to determine your fair value, then move on based on your specific IAS or IFRS. So otherwise, while choosing and helping you to choose that fair value, we shall actually say that look at the factors that help you build or come up with that fair value. Those factors should actually be much more stronger if they are observable, in other words, they are supportable, than those that are intuitive or they are actually your own subjective assumptions. So maximize the observable inputs while getting that figure called the fair value, and minimize those that you are taking as assumptions, which we call the non-observable inputs. And in that process, therefore, always go for the price that is quoted on the market, because that's more observable and more supported. Meaning that if this asset or item you're trying to fair value has an existing quoted price in the market, go by that. If there's no quoted, if that item does not have an active market with a quoted price, then go for another asset or item that is similar to it, but make adjustments. So level 1 is if there's a quoted price, to ensure you maximize the observable inputs. So go for a price that is quoted. So let's take an example. Assuming that in Kigali, in the city of Kigali, there's a quoted price for certain land, which is in a particular region, or in a particular district, or in a particular street. And that price is quoted by maybe the regulator, the government. And I want to get the fair value through the revaluation model for my asset called land in the PPE. Then in that case, I'll go for that quoted price, which is quoted by the government or by the regulator, because that is more observable, it's more supportable. And that's called level 1. In a way, I'm maximizing the observable inputs. In the event that there's no price quoted for the same piece of land I have, but there's another piece of land in the districts out there in the upcountry where there's a regulator, local government regulator upcountry, who actually has a price for land in upcountry. And that land is the same acres like mine here in Kigali. If in Kigali, I have 1 acreage of land, and there's an acreage of land in Musanze, and in Musanze, there's a price for land there, then I'll go by that in level 2, but I'll adjust for the fact that Kigali is not Musanze. I'll make those adjustments. I'm starting to bring in those subjectivity, if you realize. It's not like the other case where I know the piece of land, the price of land in Kachiru, and my land is also in Kachiru, and it's exactly the same acreage like the neighbor who's selling his land based on the market regulated price by the government. Now here, I'm quoting based on the price of land in Musanze. So in that case, I need to make that adjustment. Otherwise, if in Rwanda people don't sell land and there's no market prices of land, and yet I want to value my land at fair value using the revaluation model, then I'll sit as management and the board and perhaps get a technician called a valuer who's going to take me through assumptions that, you know, it's this acreage, it's this good, it's on this plot, it's on this street, I use it this way. And in that case, therefore, I'm going to use assumptions. And that's level 3. In that level 3, I am actually going with purely non-observable inputs, but I need to support them. So hierarchy, always go first level 1, except if you can't go for level 1, go to level 2, except if you can't go for level 2, go to level 3. I hope I've answered the person who was asking that question to repeat on IFRS 13. Okay, so let's move on. Now, I have IFRS 15. Please, this standard is a very key standard. Again, I want to summarize it. I know your lecturers have done very good on testing or equipping you with the skills of IFRS 15. IFRS 15 is called revenue from contract with customers. Now, I'll tell you that for you to recognize revenue, even if it's 1 second or 1 minute or 1 hour, 1 year, that recognition of revenue will go through 5 steps. So those 5 steps imply that in any case, first you need to identify that you have a contract with your customer. Please, this standard is for the seller. Never say IFRS 15 can also be used by the customer who's buying the goods or services. It's the one who's selling the goods or services who wants to recognize revenue from the sale of the goods or services. The first thing is to actually confirm, yes, there's a contract between me and the buyer. And in that contract, I've clearly understood what are my duties and obligations and what are the duties and obligations of the customer. For example, my duty is to actually pass over the good to the customer, and the duty of the customer is to actually pay for the good that I've given to him. And therefore, my right is to receive my money for the good I've sold, while the right of the customer is to actually receive the good that he has actually paid for. In any case, even then, there should be commercial substance in this transaction. I'm going to make a sale to earn a profit and sustain my company, and the customer is also benefiting. He's taking something that he needs at home. So I must first identify that I have an arrangement between me and the customer. That contract does not even have to be written. It can be implied. If I walk today in a supermarket, if I walk to Simba supermarket today, Simba does not have to say, do I have a contract with you to come and buy things from my supermarket? No. It is implied that you have opened that supermarket to us in the public to come and buy. And if I come in to buy, whatever I pick, I must pay. And whatever I pay, you must give. So in that case, I have identified the contract between me and my customer. Secondly, I must identify the separate performance obligations, especially where performance obligations have to be separated. So those performance obligations are the promises that me, the seller, I have made to the buyer that because of this arrangement in the contract, I shall do the following. For example, I shall provide you tuition classes, I shall provide you revision classes, I shall provide you reading materials. Those are performance obligations. Perhaps I will also provide you reading space. I'll also provide you the classrooms where you'll come and sit while I'm actually doing the class. So those are separate performance obligations. So to the extent that I can separate those performance obligations, then I'll come to step 4, where I'll allocate to each performance obligation the transaction price. But before that, step 3, I need to know what's the transaction price. The transaction price is the price I'm tagging to this particular item that I'm selling. So that transaction price, which is actually going to be determined, can even be adjusted by things like the discounts. Perhaps I'm giving a discount to my students. So that discount should be taken into consideration when I'm determining the transaction price. Otherwise, then I'm going to allocate that transaction price to those performance obligations that are separate using what I call a standalone selling principle. So I will prorate them using the standalone selling principle as my basis to say, if I was to sell tuition classes alone, how much would I charge this student coming for tuition alone for FR? Or if I'm to sell revision alone, how much would I charge the student for revision alone? If I'm to sell materials or books alone, how much can I charge the student for revision alone, or materials alone? So those standalone selling prices should give me the prorating basis against which I'll allocate the other transaction price, and then therefore I've allocated the transaction price to each separate performance obligation, and then I start recognizing revenue as and when I satisfy those performance obligations. Please remember that some of the performance obligations may be satisfied at a point in time. Like if I give you my reading materials and you have paid for them, or you have not even paid for them, but you've entitled because you've registered as my student, then at that point, my performance obligations have been satisfied at that point that I give you the reading materials, or I give you the password to access the reading materials. Otherwise, the tuition classes, I'm going to satisfy the performance obligations over time. If I have 20 revision classes or 20 tuition classes over 2 months, I'll have to satisfy them over the 2-month period. So we've talked about what a contract is. It does not have to be written, but it creates those enforceable rights and obligations on the part of me, the seller, that I have the rights, but I also have these obligations to pass. Otherwise, then in that contract, I have made a promise, and that promise is the performance obligation to transfer a good or a service, which should be distinct in a way, distinct in such a way that I can sell it separately anywhere else to this customer of mine. And that transaction price has to be allocated to the separate performance obligations using that standalone selling principle. And for me to do that, especially performance obligations satisfied over time, as I recognize the revenue coming from the performance obligations satisfied over time, I'm going to use a percentage completion method, which is going to be driven either by the input method or the output method. Input method based on the cost of inputs. How much have I input or cost I've incurred in trying to run the tuition classes of FR? And that can give me the basis to compute the percentage of work done if I've done 5 classes out of 20 classes based on my cost budget. Or I can use the output method to say how much value do I earn out of 5 classes in a total of 20 classes. That gives me the percentage of completion by the reporting date to measure the progress done by the reporting date. Otherwise, when performance obligations are satisfied at a point in time, that is the easiest. Just imagine if you walk to Simba supermarket today and you're buying a kilo of sugar. Let's assume that the kilo of sugar is maybe 2,000 francs, and you actually paid for the sugar immediately. At that point in time, Simba supermarket will actually pass over to you the kilo of sugar, and at that point in time, Simba supermarket will have satisfied its performance obligation, and it will go in its accounting records to say, I'm crediting revenue for the 2,000 francs I've received from selling sugar at that point in time. It's different from when I teach you the FRA classes for 20 classes. So it means that each time or each reporting date, if I've not finished the 20 lectures, I need to constitute how much percentage or what percentage have I finished, and then recognize revenue only based on that percentage of completion. Now, and that's the case where you may have a contract asset or a contract liability. Please take note that a contract asset is not a receivable. There's that confusion. A receivable is where I have given you an invoice for the classes I've taught. If I've taught you 5 classes and I give you an invoice for the 5 classes and you've not yet paid me for that invoice or bill, I will recognize that as a receivable. But if I've taught you 5 classes and I've not given you an invoice, but there's this knowledge of the contract in step 1 that you know your obligation is to pay me for the classes I've taught, and I know my duty is to actually teach and teach until I finish the 20 classes. So it means that the 5 classes I've taught, but I've not yet given you the invoice, is actually going to give me what I call a contract asset. So in my balance sheet, it's only when I have given you the invoice for the 5 classes that I'll call it a receivable. But if I've not given you the invoice, but I've already done the 5 classes and I've been able to articulately or reliably measure the amount related to the 5 classes, I'll call that a contract asset. Otherwise, if there's any incremental cost you've incurred to get that contract of teaching the FRA class, perhaps you had to go through an agent and paid agent's fees. Or like for us as tuition providers, by the way, to be able to teach, we have to pay some subscription fee to ICPAL. Then in that case, that incremental cost I've incurred to obtain a contract to teach FR and Rwanda is actually going to be capitalized as part of my assets. It's helping me. It's actually creating or paving way for me to actually come and teach FR and to earn income through fees that are paid to me by a student, which is actually economic benefits flowing to me as a company, which actually manifests the fact that that's an asset to me. Otherwise, an entity that is a principal in that arrangement is the entity that controls that asset, and it's that entity that shall recognize the revenue earned from that as a contract. Let's give an example. Assuming that I am selling cars in Rwanda, but I sell those cars through an agent or through a broker. So me, the owner of the cars, I'm taken to be the principal owner of the revenue. When that car is sold at 20 million, that 20 million is my revenue. And at the point in time when that car has been passed over to the customer in Rwanda, even if it has been passed over by my agent in Rwanda, I'll credit my account revenue with the 20 million francs. The person who's the agent in Rwanda is not the one who's going to recognize revenue because he's not the owner of the car being sold, and therefore is not the owner of the goods sold. What will the agent therefore recognize? The agent will only recognize the commission he has earned from the sale of the car. If the arrangement I have with the agent is that I will pay him 10% of the 20 million, then the agent will only recognize his commission as income of 2 million. While for me, I'm recognizing a total 20 million, and the 2 million I give to the agent, I'll call it cost of sale. If you're well clear with the structure of your profit or loss, there's the revenue, then minus cost of sale. So my cost of sale is that 2 million that I'm paying the agent as a commission. Now, I'll also tell you that there are cases where you can have an option or a right to repurchase. So you have sold this asset or this item, but you have an option to repurchase it, or you have a right to repurchase that asset. In that case, that will actually go to what we call a lease arrangement, or it will go to what we call a financing arrangement. So it goes to a lease arrangement where you have a sale and lease back. So that takes you, and you see there's a linkage between these standards. That takes you to a standard called IFRS 16 leases. So if I have sold a good or an asset, which I lease back, to the extent that I satisfy the requirements in IFRS 16, that yes, indeed, I transferred control over that good or that asset to the person called a buyer, then in that case, I have indeed a sale. And if I'm renting it back or leasing it back, then IFRS 16 shall actually take precedence to say that that sale and repurchase is a sale and lease back in accordance with a standard called IFRS 16. But if I sell that item to you, but in substance, I have not sold it. In other words, I still maintain control over that asset, including the substantial risks and rewards associated with that asset, then actually the money you gave me for that asset was not actually sales proceeds. It was not revenue from sale of that item, but it was actually a financing arrangement. It's like I borrowed money and used that asset as security. So in that case, a standard called IFRS 9, financial instruments, where there's financial liability, will come in there. Please be mindful of those situations where your examiner can be very original to actually indicate either a sale and lease back or to indicate a sale, and actually there's a seemingly looking like a lease back, but in the first place you didn't sell. So the sale transaction did not pass because you didn't substantially transfer the risks and rewards and therefore control over that item to the buyer. So in that case, it was not a sale and lease back. So it's not IFRS 16 leases, but it's actually IFRS 9 financial instruments, and it's a financial liability. Others, an obligation to repurchase an asset for less than the original selling price will usually give rise to a lease or to a sale with a right to return. And you need to actually be mindful of that, to look at what we call the abnormal profit or the abnormal loss. In this case, that will be an abnormal loss. So we have the abnormal profit or abnormal loss. Others, an obligation to repurchase that asset for not less than the original selling price will actually give rise to a financing arrangement. In that case, we bring it to IFRS 9. Now, please never recognize revenue when you have a bill and hold arrangement. At times, your lecturers may not go to the detail of this, but it's part of the syllabus, and be mindful of that. Let me give an example. Assuming that I went to a warehouse, hardware, let me take a hardware, where people are selling cement, and I buy 100 bags of cement, but I don't need all the 100 bags of cement today. So the company which is recognizing revenue is the company that is actually saying that I have actually sold 100 bags, but the customer has not taken all the 100 bags. Why? He has just paid up front to say, I'll keep coming to pick as and when I need to take the bags. So the hardware company receives money for 100 bags, and that company says, I'm debiting cash and bank, but the credit is not revenue. Why? Because they're holding on to control of these bags. They can decide, and they have the choice of deciding which bags will actually be given to this customer at a later date when the customer actually wants them. So in that case, revenue will not be recognized by that hardware company because it has not transferred control over access and use of those bags of cement to the buyer who does not need them until further use or further notice. So be mindful of those situations where the examiner may actually create that kind of scenario. I've talked about a case of consignment where this person selling cars in Rwanda, but through an agent, and the cars become a consignment stock, and the person who's selling the cars is there for my agent. The question then will be, who should recognize that as inventory to be sold and therefore recognize as revenue? Should it be me, the owner? If I'm the principal, yes, it should be me. Or should it be my agent? If I've transferred the risks and rewards to that agent, yes, then it will be the agent. Please be mindful of the Indians then who are selling cars in Rwanda, and they could actually be selling those cars on behalf of the Japanese in Japan, and they are selling them on a consignment basis, either because they have no control, so that they have actually just access as agents, and they are actually authorized to sell as agents in Rwanda, but they are not the owners. Or the owners in Japan have even passed over control to say, we have actually given those cars to you. You have the choice of how to sell, when to sell, and the other terms and conditions. So in that particular case, we want to see who has the inventory and subsequently revenue, and who has the revenue in that case. So that is IFRS 15. Okay. Somebody is asking a question, so I'll keep going to the chat zone, like you heard from Felician, where I'll keep seeing what questions are in there. So I see somebody saying, sorry, lecturer, what's the difference between standalone price and the contract or transaction price? So let me just answer it using an illustration. If you came to study FR in my school, and I'm not saying that this is exactly how it happens, but as an example, if you came to study FR in my school, and I tell you that I'll teach you FR for 200,000 francs, in that money, you'll receive tuition class, you'll receive revision class, and you'll receive also online materials or reading materials. So in that case, that is what we call a transaction price. 200,000 is the transaction price or the contract price. However, the question is, what are the separate performance obligations? Or how can I, first of all, there are 3 performance obligations. 1, I have to teach you the FR. Secondly, I have to do the revision for you. Thirdly, I have to give you the books. So in that case, again, we shall say, how do I allocate that 200,000, which is the contract price or transaction price, to those 3 performance obligations? To allocate that 200,000 to the 3 performance obligations, I need to use the standalone selling price to say, what if John or David came to my class and only wants tuition? If I have a price list to say that if you want only tuition for FR, the amount of money is 120,000 francs. If John or David wants only revision, and I have a price list to say, if you only want revision, the amount of money is 70,000 francs. Or if John or David says, me, I only want the books, I don't want your classes, I don't want tuition, I don't want revision, and I say the amount of money for the books is 50,000, then that is what we call stand-alone selling price for tuition is 120,000. Stand-alone selling price for revision is 70,000. Stand-alone selling price for books alone is 50,000. I'll use those as a basis to allocate the other 200,000 in step 4 out of our 5 steps to say that if in total tuition 120 alone plus revision alone 70, in total that's 190, plus books alone 50, that's in total 240. Then I'll say tuition alone 120,000 divided by the total of 240. For the other 200,000 is like 120 over 240 is a half. Is like 50% of 200,000, which is 100,000 is how much I allocate to the transaction price of 100,000, sorry, 200,000 to tuition alone. So that tuition alone was discounted, if you realize, because of a bulk purchase. The student is buying in bulk, tuition plus revision plus materials. So in that case, that transaction price based on bulk and discount was 200,000, but standalone selling prices, if they come to buy on the tuition or revision or books, that's what we call standalone selling price. I'm hoping the person who asked the difference is getting it clearly. So if you know, some tuition providers do that if you come for all the three, 200,000. If you come for each individually, tuition alone is this, revision alone is this, books alone is this. And you can even stretch it beyond just tuition providers or this industry. You can take it to other sectors. That yes, if I went to what TV station is there, package is there, my memory, yeah, DSTV. If you want to DSTV, yes, they will tell you that if you actually want a package that has football, sports, and has news and has this is the price. But if you only want the one that has sports alone or once has news alone, so I'm just giving all those as examples. So that alone is standalone. That altogether is what we call the contract or transaction price, where there are separate performance obligations and you want to allocate that contract price to the separate performance obligations. Another person is asking, should the contract be written or signed or certified every time for its validity? I said no. It does not have to be written. It does not have to be signed. It does not have to be certified. Otherwise, I gave an example that if you went to actually that supermarket called 2000 or Simbap supermarket, then, and you're only entering in there to buy a kilo of sugar, you will not have to say, let's sign the contract to sell me the kilo of sugar. No, it is implied. It can even be verbal. I can walk to a shop to buy a kilo of sugar and just tell the shopkeeper, give me 1 kilo of sugar. And that shopkeeper expects you to pay before he gives, and to pay the price, which is set 2,000 francs before you actually take the sugar. So that means that that contract does not have to be written. It can be implied, it can be verbal. Okay, I'm hoping I've also answered that person in the process. Okay, so back to our summaries. There's IS2 inventories, and there's also biological assets, IS41. IS41 is on agriculture, but there's a very big section there which is on biological assets. Now, by rule of thumb, when you talk about inventory, at the reporting date, inventory shall always be measured or valued or carried at an amount that is based on the lower of the cost of that inventory and the net realizable value. And that's why net realizable value is the concept of fair value under IS2. You don't have to go to IFRS 13 for this. The moment that net realizable value is lower than cost, then you write down that inventory to the net realizable value. Implied in that statement is that you're writing it down by recognizing an impairment loss, so that inventory has suffered an impairment loss. So again, IS2 handles its impairment loss. You don't go to IS36, where impairment loss generally is actually covered. So the net selling price is the price you sell that inventory, less the cost of disposal, including the cost to complete that inventory to be ready and available for sale. Otherwise, the cost includes all costs you've incurred to bring that inventory in the present condition or location that makes it ready for sale or at that reporting date. Those costs you've incurred up that point of the reporting, some of those costs could actually make that inventory still work in progress or finished product. But the cost you've incurred up the date that you are reporting to ensure that that's the present condition and location of the inventory. Specifically, inventory is going to be measured using specifically the cost of inventory is going to be determined using either first in, first out basis or the weighted average cost method. Please, IS2 no longer uses the last in, first out. So I'll be very specific here to say not last in, first out. So we don't use the last in, first out basis anymore. So we don't have that anymore in IS2. So to determine that cost, especially if these are so many units of inventory and there are so many, like so nails, like maybe you are talking of 1,000 kilos of nails and those are tiny nails. Either you are going to use the first in, first out basis, or you can get a weighted average cost you've incurred in getting those nails presented in a condition that you have them at the reporting date. Please, not last in, first out. Now, otherwise, the cost of inventory is recognized as an expense in the period in which the company is actually recognizing the revenue that you're selling. To actually have a matching concept, you match the cost with the revenue earned from selling that inventory, and that cost is going to be taken in what we call cost of sales. So first revenue, then match it with the cost of sales, and that cost is the cost of the inventory that you've sold. Any write-down of that inventory because it's actually down to the net realizable value, which is less than cost, is recognized as an expense. Naturally, you may call it impairment loss, but it's actually going to be an expense. So that then any reversal or subsequent reversal of that loss that you've made is actually going to be now recognized in the financial statements, as a P&L income in those periods in which that reversal takes place, because in any case it was based on an estimate, and changes in estimates are accounted for prospectively. Now that's IS2. Please, IS2, purposely for your exam, usually this is the key thing, the one I'm highlighting. That's the one that will run your day. But the examiner can be very, very tactical to say that I want you to actually measure that cost. And it gives you information that should help you compute and measure the cost in the figures that you're presenting, especially standalone questions that have inventory. Or I want you to measure that net realizable value, giving you the figures relating to the selling price less the cost to sell. So it may ask you to do that. And I want you to recognize that write down from the cost to the net realizable value. So be mindful of that. Otherwise, IAS 41 is the one that deals with the biological assets. IAS 41 is big. It handles the entire sector called agriculture. But within agriculture, we have what we call biological assets. And biological assets in this case are living assets, like animals or like plants. So they are living animals. So those living assets or living plants that are undergoing transformation, this is usually biological transformation. It's natural. This animal is growing from a little animal to a big or mature animal. Or this plant is growing from a little plant to a mature and big plant. From a little mango tree to a big and mature mango tree. So therefore that becomes a biological asset. So under IAS 41, if those biological assets are bearer plants, then they are not part of IAS 41, they become IAS 16. So if these are bearer plants, let me put it here, that if the biological assets, if these biological assets are bearer plants, then these are included in IAS 16 as property, plant, and equipment. They are not therefore biological assets under IAS 41. So these therefore are not biological assets under IAS 41. Let me give an example. An example is a mango tree. So a mango tree is a plant, but it bears fruits called mangoes. So that mango tree, as long as this is an agricultural product or activity that is well managed by the company, please don't go for those mango trees in your compounds at home. Don't go home to say that this mango tree is my PPE. And therefore you are actually boasting around with your neighbors or friends or relatives saying, for me, I have a PPE in my compound, which is the mango tree because my lecturers told me that. It must be a well-organized agricultural activity. So there are persons or companies whose business is to actually have what we call plantations of mango trees from which they actually get mangoes, which they sell either as mangoes or they actually squeeze and make what we call mango juice. So the mangoes, when they're still on the mango tree, is actually the bearer product, is the product that that mango tree is bearing. And this mango tree is a plant. So that mango tree for those companies or individuals is property, plant, and equipment under IAS 16, whereby under IAS 16, ordinarily, they will be carried at cost or using the cost model. Because here in IAS 41, ordinarily, biological assets under IAS 41 are carried at fair value, not at cost model. So that's why we take those out and take them to PPE. Again, be mindful. Your examiner can actually put in a scenario in there and you see mango trees and it says this company's business is to actually produce mangoes which are planted within their organized plantations in a certain region, maybe in the north part of the Rwanda, which is fertile enough. And they are saying that therefore this agriculture activity is presented in their financial statement. And now you're starting to think in accordance with IAS 41 and you're thinking those are biological assets under IAS 41. No. Those now become property, plant, and equipment, and IAS 16 takes care of those. Otherwise, the other biological assets, which are animals, Like if this company or this individual has cattle or cows, which are actually used for milk or for meat, those are actually going to be biological assets, which are not plants. They're not plants. Those are falling under IS 41. They are biological assets there. Please take note that, again, there's a clear difference between biological assets and inventory. So that animal called the cow, the milk it's producing is the inventory. But inventory when it has been taken out of the cow. When still in the cow, it's part of the cow, and therefore it's part of IS 41. When you take it out of the cow, then it becomes inventory. At that point that it's getting out of the cow and getting into your jerry can. I hope you understand that. So there's that connection. That's the reason you see me connecting inventories to biological assets, because biological assets actually result into inventory. There are biological assets. There are bearer plants. Sorry, there are plants that may not bear something. They just continue as they are, like a sugar cane. So there are individuals or companies that whose business is to actually grow sugar cane. So that sugar cane will grow, and they'll actually go and pluck it off or take it out of the garden and actually go and actually create sugar out of that. So while it's still in the garden, it's actually going to be a biological asset. The day you go and actually kick it out or cut it out of the garden to start making sugar, then it actually moves from biological asset IS 41 to become your inventory. So that's when it becomes inventory. So here I'll tell you that under IS 41, biological assets are always measured at fair value. Yet if it's IS 16, they will be measured at cost. Otherwise, if you cannot determine their fair value, which is very rare, IS 41 says always possible to determine their fair value. If you can't determine their fair value, then you shall use the cost model. And in that case, you'll use cost model, which is similar to IS 16, and even assess them for impairment loss under IS 36. Now, otherwise, if you maintain the fair value, then each year under IS 41 biological assets, you need to assess their fair value. And that fair value change, which is either gain or loss, is taken to the profit or loss immediately. But that gain or loss in the disclosure notes must actually be split into how much of that gain relates to the fact that that animal, that cow, has grown older than last year. It's bigger than last year. Last year it was 10 kilos, now it's 15 kilos. So part of the fair value gain is the physical change from a 10 kilogram animal to a 15 kilogram animal, because that change is part of the reason why today's fair value is different from last year's fair value. But it's also possible that this year the price of cows has changed, and therefore part of the reason for the fair value change is the price change. The cow's price has changed this year than it was last year. So that disclosure is appropriate in the notes. On the face of the P&L, just put the total fair value gain. In the notes, break down that fair value gain in the amount that goes to the physical change and the amount that goes for the price change. Now that takes me to IS 16, property, plant and equipment. This is a common standard. You will not get out of this exam without doing something under IS 16 PPE. Please, an item of PPE is only recognized when the recognition specific criteria in IS 16 is satisfied. That criteria there is that in IS 16, for you to say I have a PPE to put in my balance sheet, it must be probable that future economic benefits associated with that PPE will flow to the company, and the company can reliably establish the cost or the measure of this asset. Now, when that is the case, we shall initially measure that asset at cost. And cost here includes the purchase price. So the cost here is the price you've paid to buy that asset, either the purchase or the construction cost. The construction, maybe you have self-constructed it. So that construction or purchase price plus the direct transaction costs. Maybe to purchase this asset, you had to go through a lawyer and you've paid legal fees to the lawyer, and that was unavoidable. You needed the lawyer to help you come up with the contract to buy that asset from the seller. Then we shall also say plus any capitalized borrowing costs, the capitalized borrowing costs. Under IS 23, I'll look at that later. IS 23 is borrowing costs. So assuming that you borrowed money from a bank to buy that asset, and by the time you got the asset ready for intended use, therefore you have already been spending on borrowing costs, then that borrowing cost you've spent up to the day the asset is ready for use should be capitalized as part of the initial cost of the asset. And where applicable, if you need to dismantle or you're required to dismantle or you have a present obligation to decommission or dismantle this asset, we shall also say plus the decommissioning cost. The decommissioning or dismantling cost. removal costs. At times people want to understand it more by saying removal costs. If there's a present obligation, you have a present obligation to dismantle or to remove or to decommission this asset under a standard called IAS 37. So this is what gives us the initial cost of this asset. Okay. Otherwise, subsequently, after this initial recognition, after you've initially recognized the asset based on that initial cost, subsequently, we shall either carry that asset using the cost model or using the revaluation model. In IAS 16, most cases, it should be the cost model, which is very simple, that cost model is to go back by the historical cost, that cost you incurred at the point of the initial recognition, minus any accumulated depreciation, minus any impairment losses. Otherwise, if you're using revaluation model, then in that case, you are actually going to have conditions that must all be satisfied. And it's those strict conditions that encourage you to always use the cost model, because these conditions must all be satisfied. Now, before I look at those conditions, I'll tell you that if you go by the cost model, or even both the revaluation and the cost model, you must always have these assets depreciated. The PPE is always depreciated, whether using the cost model or the revaluation model. And that depreciation is going to be based on the systematic basis over the useful life. And in this case, the base will be the cost less the estimated residue value, which residue value is estimated and can change over the years, that estimated residue value, and you are applying a method to depreciate that is commensurate or related or equivalent to the rate at which you're consuming that asset. It could be a reducing balance method, it could be a straight line method, and it's going to be over the useful life of the asset, where you continuously every year end continue to review the life of the asset and also the residue value of the asset. So every year you need to continuously review the life of the asset and the residue value of the asset. Otherwise, any significant costs that have been incurred or have to be incurred at the end of the useful life of the asset are going to be recognized as part of the cost element, which is what I call the decommissioning cost. Maybe you have to remove that asset or to dismantle that asset. So in that case, those are going to actually be the decommissioning cost, which you should have even recognized right from the start, except if at the start you had no present obligation. Or they can actually, so meaning that they would increase the cost of the asset, and over the life of the asset, you're depreciating the asset without inclusion of that dismantling or removal costs. Or you can actually have those dismantling costs directly go to reduce the residual value of the asset. So depending on the policy of the company. In your exam, the dismantling cost will be used to increase the initial cost of the asset than reducing the residual value of the asset. Okay, so I'll tell you that in either case, the amount is effectively going to be depreciated or expensed over the life of the asset. Now, remember that if we have the revaluation model, there are conditions that strictly must be passed. For example, you are going to have to revalue this asset sufficiently regular or with sufficient regularity. So regularly, you must revalue. That regularity is not time linked in IAS 16. It depends on the company, that what's actually regular for the company. Otherwise, the entire class must be revalued. Don't say, I'm revaluing only the cars in Kigali city, but not the ones up country. You must revalue all the cars you have as a company, whether some are in Kigali and others are outside Kigali. They must all be revalued because they are all in the same class. If you have revalued this asset and the asset has a revaluation surplus or gain, such a revaluation surplus or gain must traditionally be recognized in the other comprehensive income. It's unrealized until you use the asset or until you sell the asset. So because it's unrealized, first reserve it through the other comprehensive income to the revaluation reserve. So reserve it, be prudent and first reserve it, wait until you use the asset to benefit from that uplift value in the asset. Or wait until you sell it and then you are recognizing that gain. But please, that gain is never reclassified to the P&L. That gain can only be realized either through sale or through use, continued use, but directly within equity through the statement of changes in equity from the revaluation reserve account to the retained earnings account. If you have a reduction in the revaluation when you revalue, then that's a revaluation loss or revaluation deficit. That revaluation loss or revaluation deficit shall be taken to the profit or loss account. except if that asset that has been today revalued with a loss was previously revalued with a gain. Then today's revaluation loss, before you take it to the P&L, first take it to the other comprehensive income to the extent or to the maximum of the outstanding credit balance of the revaluation reserve that is still standing for that asset at the time that you're revaluing with a loss. Let me give an example. Assuming today you are revaluing this asset for the second time, and the first time was last year. Last year you revalued it and it had 10 million revaluation gain. And today you have revalued it with a $15 million revaluation, 15 million francs revaluation loss. So last year you had a 10 million francs revaluation gain. Where did you take the 10 million francs? You took them to the other comprehensive income and they went to the revaluation reserve. Today in year 2, when you're revaluing, this time around with a 10 million francs loss, then we shall say today's, sorry, let me turn them around. So yesterday or last year, you had a revaluation gain for that asset and it was 10 million francs. Today, you have revalued with a loss and it's 15 million francs. So we shall say that today's revaluation loss, 10 million or up to the 10 million, as long as that 10 million is still in the reserve account, up to that 10 million is going to be debited in the other comprehensive income to go to the revaluation reserve to clear out that credit in the revaluation reserve. Other is the extra 5 million, because today's revaluation loss is 15 million. There's that extra 5 million above the revaluation gain you made last year of 10 million. So today's excess or extra 5 million is only the amount I'll debit to the P&L. Please look out for that scenario in the exam. Your examiner loves that, to give you a situation where today's revaluation loss is for an asset that last year had a revaluation gain, and there's still a reserve in the gain, and it's using figures like I've given you. Last year it was 10 million, now it's 15 million, and they want you to account for this year's revaluation loss of 15 million. Not all 15 million today goes to the P&L. You first go and look for where the other gain is related to the same asset, because you cannot be having two revaluation differences for the same item in two different places in the financial statements. Go and clear out that reserve and then have only one outstanding item in the financial statements, which is the balance excess loss of 5 million francs, which goes to the P&L. Otherwise, again, IFRS 16 requires to have some disclosures that must be made in the notes. At times, the examiner does not go detail in some of these disclosures, but it's good for you to take note of disclosures, because for 1 or 2 marks, the examiner may ask you to mention or to state or to explain any 1 or 2 relevant disclosures that must be done in the notes to the financial statements in respect to items of PPE in accordance with I-16. So there you are. Those are some of the disclosures that must be made in the notes to the financial statements. Now, before I look at a practice question, which I want to pick from one of your past paper exams, I'll want to look at one or some of the charts that have come in. So somebody is saying, sorry, lecturer, what's, okay, so that's one we saw. Should the contract be written? I did that. Then common measurement of biological assets. Okay, so I did that. I don't know whether the student wants me to get back there. I told you that biological assets are measured based on fair value. Fair value is that fair value in accordance with IFRS 13, to say that if I have a biological asset, if I keep cattle or cows and I have 1 million cows or 1,000 cows as part of my farm, and it's an organized farming activity, and it's there for my business, and therefore they qualify to be biological assets under IAS 41, then I'll carry them at fair value. It's assumed by IAS 41 that always fair value will be easily determinable or accessible. So I will know how much do they sell cows of this size, of this nature, in Rwanda or in the neighborhood. So that would be the fair value I'll use. If that fair value is different from last year, then I'll have a fair value change. That fair value change is either gain or loss, which I'll recognize in totality. And the profit or loss, always fair value gains for biological assets, take them to P&L. Please don't confuse it with revaluation gains for PPE. Revaluation gains for PPE, take them to other comprehensive income. But fair value gains for biological assets under IAS 41, take them to profit or loss. But in the notes, go and break down that fair value gain to say how much of that fair value gain for those cows is because the cows have grown bigger because of the biological transformation. I told you that biological assets undergo biological transformation. They grow. Last year, those cows were smaller than now. They've grown. They've eaten more food. they've grown, they've also aged, they are 1 year older. So that is a physical change. To say in that total fair value gain, there's an amount that goes to physical change and there's an amount that goes to price change. Please, in your FR exam, your examiner will not expect to technically examine on how to compute and separate those two gains, except if the examiner mentions how much is physical change, how much is price change. But please, the examiner will only want you to explain that change in the value or fair value is attributed to those two elements, price change and physical change. So I hope I've answered the student who's asking how that measurement of biological assets comes in. Okay, now there's that picture which I need to remove. Oh, it has finally gone. I was trying to see how it goes off. Okay, so I want us to look at a past paper exam, and I'm going to open the April 2022 exam. I want to look at section A. There's a question number 2 there, part C, which is on a case of a company called Rugoba Goba. And I'm just opening that paper now, April 2022, there you are. And I'm looking for question number 2. Okay, part C. So this is question 2. So I'm going to part C of this question. So there you are. So always read the requirement first. So always, it's important to read the requirement first. So in this case, I'll see the requirement down there says, using the information provided, and it's 8 marks. Prepare, so you'll be good in time allocation in terms of how many minutes do you need for 8 marks, including reading the requirement and also planning your answer and writing down the answer. Okay, so they're saying for 8 marks, using the information provided, prepare an extract or prepare the extract for Rugoba Goba's statement of changes in equity as at 31st December 2020, reflecting the implications of the revaluation of the machine above. So here, extract. So I'm just going to prepare extract. So if I start explaining, I'm not actually answering the question. Let me see if my highlighter works. So in this case, I'm only going to prepare an extract. I'm not going to explain. So it's so much about mathematics figures in there. But while I do that, I'm specifically looking at statement of changes in equity. So it's statement of changes in equity. Sorry, my highlighter is not picking it the way I wanted it. So I'm only going for statement of changes in equity. I'm not going to the P&L. I'm not going to the balance sheet, but statement of changes in equity. And I'm reflecting the implications or the effect or the changes arising due to the fair value changes. So due to the revaluation of the asset that I have up there. So let's go to the scenario. Okay, so at the start of the scenario, part C, they're saying that Rugoba Goba Tea Limited is a major producing tea company in Rwanda, and it operates in the western region of Rwanda. The accountant of Rugoba Goba Tea Company is pursuing CPA and has learned about the reclassification of a revaluation reserve in accordance with IS-16. Recall, IS-16 prohibits you to reclassify to the P&L directly, but you can actually reclassify in between or within the statement of changes in equity from revaluation reserve to retained earnings. Okay, so this accountant has approached you seeking advice on the accounting treatment of their property, plant, and equipment in the financial statements. So the moment I see this word PPE, property, plant, and equipment, I know the accountant is, or the question examiner is examining me on I-16. Even if this company is in agriculture, so I'm not looking at biological assets now, because the question is asking for advice on PPE, I-16. So below is the information extracted. So please, before you leave that, be mindful that these companies that are in agriculture have both biological assets under IS-41 and PPE. They have in the plantations, if this tea growing is not a bearer plant, so that plant tea, they harvest all of it, they kill all of it and go to take off the tea leaves, then that is biological asset. Over the period it's growing, IS-41. But the machines they use to pick out the tea in the gardens, or the machine they use to transport the tea to the factory, or the machine they use to actually manufacture the tea out of the tea leaves, or make the tea leaves, or the trucks they use to drive the tea leaves to the customers are PPE, property, plant, and equipment. So please be mindful that they also have PPE. So leave alone the fact that I've concentrated on what's in their garden, which is IS41, but outside the garden, they are using machines. Okay, including the building where these machines or where the things are kept. So below is the information extracted from the trial balance of Rugoba Goba Tea Company as at 31st December 2020. So this is just an extract. So it's not the entire trial balance. So they've picked out only 5 items in the trial balance, one of which is PPE at cost and accumulated depreciation of PPE. By this date, 31st December 2020, it has accumulated with depreciation of 400,000. So its opening, or so its net book value or carrying value is 800,000, which is 1.2 million. This is rounded off, I think 1.2 billion, but let's go with the figures in here, rounded off, like 1.2 million minus 400,000. So hence, that's a net book value of 800,000. Now, others under equity, they have ordinary share capital as 900,000, retained earnings as 400,000, and revaluation reserve as 80,000. Now, please note, everyone you're given the information in the trial balance, until explained otherwise, if this information points to items of equity, we assume that those are the opening balances of equity if they're picked from the trial balance. Except if when the information tells you that this retained earnings is the retained earnings at the end of the year, or this revaluation reserve is the revaluation reserve at the end of the year. It's assumed that those are the opening items in the statement of changes in equity for these items that relate to equity. Okay, so they go on to tell me that included in the PPE is a machine. So within these totals for PPE is a machine that was acquired on 1st January 2018. Dates are very important. If this year is 31st December 2020, then this was acquired 2 years ago. So January 2018 to December 18 is year 1. Then to December 2019 is year 2. So this is year 3 of this asset or this machine. Now this machine was acquired at a cost of $200 million. That is years back, with an estimated useful life of 10 years. If they don't tell you which depreciation method to use, or as the examiner assumes, or as the examiner wants you to assume straight line method of depreciation. If they don't tell you the residue value, or as the examiner wants you to assume a nil residue value. It's in the straight line method where you use both the useful life and residue value. Please don't use those two when it's reducing balance. Straight line method of depreciation, use the life of the asset and also residue value. Reducing balance, you only use the percentage rate of the depreciation against the opening value of the asset, full stop. You don't go by the life of the asset, you don't go by the residue value of the asset. I'm hoping students, you're putting these things somewhere on pieces of paper, because some of them I'm talking. I know you'll receive the recording version, but it's also important that you keep picking those tips in the exam to have your time very fine and very friendly to you. If the examiner says use the reducing balance method, but he has given information about an asset, including the useful life and the residue value of the asset, please don't use those two. They have no importance when computing depreciation using reducing balance. But when the question is using straight line method, and they've given it the useful life and the residue value, please get the depreciable amount as the historical cost minus the residue value. That gives me the amount that what we call depreciable value of the asset, divide it by the number of years to get the depreciation per year, and it's going to be the same uniform depreciation figure per year because it's straight line. Okay, let's go back here. So the useful life is 10 years. And the question is silent. Again, when the question is silent, always use straight line method to depreciate. Never assume reducing balance until the examiner puts it in the question that the depreciation method is reducing balance. Otherwise, we are told that at the start of this year, 1st January 2020, the machine was revalued to 180 million francs, but the useful life remained the same. So at the start of this year, 2 years of the 10 years are down. So they are now on the 8 remaining years. So use that information up there to prepare an extract for Rugoba Goba's statement of changes in equity as at 31st December 2020, reflecting the implication of the revaluation of the machine. I don't have to explain here. So in this case, this is what I'll do. And even if I have an explanations, they will be so simple. So I have a freedom of using my Excel. Remember, in the exam, your paper is paper-based. You have to write here. I don't see you. You're not in front of me. Sorry, you're not. I'm not physically with you. So I can use my Excel. So I have no board to use there. Otherwise, I can comfortably use my Excel, or I can use the word processor, but Excel can help me on the basis that I'm only going to calculate. So if I'm calculating, and what I need here is an extract of the state. Let me increase this font here so that it's visible enough. Okay. So if I'm looking at an extract of my statement of changes in equity, then I know that my statement of changes in equity will be driven, the columns will be driven by the information I have in the scenario. So from the scenario, I see that I have under equity, I have share capital, I have retained earnings and revaluation reserve. Those three items will actually give me my structure for the statement of changes in equity. So I'll come to my structure. Sorry, where's the Excel? Yeah, here it is. I come to my structure to say I have the share capital. Okay. I also have the revaluation reserve. Sorry, the retained earnings. Maybe let me put that as retained earnings and the revaluation reserve. Let me wrap this up so that I don't lose sense of the size. Then the revaluation reserve. Okay. So in this case, I'll say that the opening balances, which are the balances on 1st January 2020, are basically the figures that are usually in the trial balance. I'm abbreviating trial balance as TB, and I'll go back to see the figures given to me. The figures given to me were 900,000 for share capital, 400,000 for retained earnings, and 80,000 for the revaluation reserve. So 900,000. Okay, then 400,000 for retained earnings and 80,000 for the revaluation reserve. I hope I'm correct there. Just double check. Just double check. Yes, we are correct. Then we're told that included in the PPE. So included in the PPE is the machine that was historically bought at 200,000 with an estimated useful life of 10 years and has been revalued to 180,000. So I'll have a working for that to say that I have a working down here, which I will call working one, which is the revaluation of the machine. And I'm using the principles of IAS 16. I don't have to state that word, IAS 16. I just have to go straight to my business, which is to revalue, to say that when the cost 2 years ago, 1st January 2018, was $200 million. Recall our figures are rounded off, so it's like 200,000 there. I'll say that less the annual depreciation, and I'll have this accumulated over the 2 years. Accumulated over the 2 years, 2018, 2019. Yes, yeah, over the 2 years to 31st or to 1st, you can say to 31st December 2019. Okay, let's double check whether that's when the revaluation took place. Yes, 2019, 1st January 2020, so 31st December 2019 is good enough. Sorry, 31st December 2019 is good enough. So implied there is that my annual depreciation, and I can have it on site, that my annual depreciation should be that 200,000 divided by 20 years. Sorry, 10 years. The asset is a 10-year useful life. So each year, the asset has a depreciation of 20,000, right? Then I'll say cumulatively, this is going to be 20,000 times 2 years. So that's 40,000, meaning that therefore the carrying amount of this asset on 1st January 2020 was 200,000 minus 40, which is 160. But this asset was revalued on that date. So the revalued amount on that date, 1st January 2020, was 180,000. Let's go back and check whether it was 180 million. Yeah, it was revalued to 180 million. Fine. So that's 180. We're rounding off to thousands. So that means that there's a revaluation gain or revaluation surplus. So we have a revaluation surplus or gain on 1st January 2020, and that's the gain in respect of the fact that it's revalued to 180 from 160. So it's a gain of 20,000. Which accounting entry, the accounting treatment for this gain is basically to debit the asset. So I'll debit the PPE with that 20,000, while the credit goes to the revaluation reserve, but through the other comprehensive income. So I'll credit the other comprehensive income, and this will go to the revaluation reserve, which is in equity. Revaluation reserve is the item in the statement of changes in equity at that $20,000. So that credit, because I'm preparing a statement of changes in equity, I'll come to my statement of changes in equity and say I have a revaluation gain. A revaluation gain on the machine. That machine within the PPE. Within the PPE coming from my working below or working one below, and that gain increases the revaluation reserve at the start of the year by 20,000. So I'll pick that 20,000 from there. Okay, when I do that, then it implies that I'll come to my working and say working two, I need to pass over or release that revaluation gain to, first of all, at this point, it's a reserve because you're prudent, you can't realize it until you continue to use the asset. And then there you are, you're happy to have a gain that you are realizing through additional output or good performance. Otherwise, you can actually wait until it's disposed of. So here, let's say working two is to actually have the PPE. So my PPE, I'll say that historically it's carrying amount. It's carrying amount on 1st January 2020, based on the figure above, is the depreciated figure, which was 160. Remember that 160 there, and then we shall say plus the revaluation surplus. Revaluation surplus or gain, which is coming from that working one above, and that revaluation gain is the 20, which is this debit here, implied that your revalued asset, the revalued amount of the PPE or machine on 1st January 2020 is going to be the 180, which is that revalued amount. It's going to be the 180,000. Now we shall come in to say less the depreciation. Less the annual depreciation in this year. The annual depreciation in the year ended 31st December 2020 is now going to be based on that revalued amount of 180 million or 180,000 divided by the 9 remaining, is it 9 or 8? Now 8 remaining years, because 2 years were accumulated up there, 2 of the 10 years were accumulated. So now you are saying 180,000 divided by 8 remaining years. So mean that your annual depreciation is now this, implying that the closing balance, the closing carrying value of this machine within the PPE at the end of this year is going to be 180,000 minus 22,500. So that's the closing balance of this machine by 31st December 2020. Now, the reason I'm using this, or I'm getting to this working, is to say that therefore, if I go to working through, which is to look at how much of the gain has been transferred or should be transferred as realized directly in equity to the retained earnings, it's going to be based on the amount of the excess depreciation. So here we shall say that working three is the revaluation gain to be transferred to the retained earnings on 31st December 2020. So this is going to be based on, the excess of the annual depreciation this year, the annual depreciation in the year, and that year is the year ended 31st December 2020, and that figure is from working two above. So that annual depreciation in working two above is that figure you've just picked up there, which is the 22,500. So minus the annual, or what I would call the normal depreciation before the revaluation, the normal annual depreciation before the revaluation surplus, the normal annual depreciation prior to the revaluation. So before the revaluation, our annual depreciation was up there. So I'll pick it from working one. I'll say that I'm picking this from my working one. So in that working one, that annual depreciation was, I'll go to working one. Our annual depreciation used to be 20,000 per year before the revaluation. So mean that we have an excess depreciation, and this excess depreciation is going to be the basis for our transfer, the basis of the amount of the revaluation gain that will be transferred to the retained earnings in this year. The retained earnings in this year. And this is the year ended 31st December 2020. So the amount that we are going to transfer is going to be based on the difference between 22,500 minus 20,000, which is actually 2,500. And how do I account for that? The accounting treatment for this, the accounting treatment for what I'll call the realized, at times we call it transferred or realized revaluation gain, transferred or realized revaluation gain in this year is going to be to debit it out of the revaluation reserve. So when I debit it out of the revaluation reserve, I'm reducing it from the revaluation reserve because it has been realized. And this is directly in the revaluation reserve. Don't take it through the other comprehensive income. So this is directly in equity. So it's directly within equity, not through the other comprehensive income. So you don't debit it out through the other comprehensive income. So we shall debit the revaluation reserve directly in equity with 22,500, while the credit shall increase the retained earnings. So my retained earnings are going to be again directly in equity, In other words, not through the profit or loss. So this is not through the profit or loss because I-16 prohibits you to have reclassified it through the profit or loss. You should have taken it directly in the statement of changes in equity in that line called retained earnings. That double entry, I need to take it in my statement of changes in equity up there. By saying that in my statement of changes in equity here, I'll come in here to say that the transferred or the realized, revaluation gain in the year. And I will say this is picked from working three, where I'm transferring it from the revaluation reserve as a minus, because it's being reduced from there since it's now realized. And I'm taking it to the retained earnings as a plus. And I'm picking it from that working three. So whereby I'm now taking it or crediting it in the retained earnings account. And by so doing, I am now having my revised figures or so these are going to be my revised balances, which are just an extract. This is just an extract. It's not to say everything has been picked, but based on the information given to me. So share capital continues to be 900,000, while now the retained earnings has now become 400,000 plus the 2,500, and the revaluation reserve has now reduced. Initially, it increased by 20,000, and it has gone down by 2,500. So it increased at the start of the year and has gone down at the end of the year by that 2,500. And therefore, it's closing at 97,500. So there we are. In that case, we have dealt with a very critical area of your topic I-16, which I-16 is always in there, which is basically looking at revaluation reserves revaluation of PPE, especially where we have a revaluation gain, which has to go to the other comprehensive income. And in the event that this revaluation gain is realized over the time and over the use of the asset, then a part of it on a straight line basis is going to be taken to the retained earnings directly in equity, not through the P&L, because I-16 prohibits you to reclassify it through P&L. You actually reclassify it directly within equity from the revaluation reserve to the retained earnings column. Okay, so as I'm done with this, there's a question that somebody is still asking on biological assets. Do biological assets depreciate over time? Please note, all items or assets that you're assessing at fair value every year never are assessed for depreciation or impairment losses. Take it as a rule of thumb, write it somewhere, that any asset which is measured based on fair value every year is not assessed for depreciation and is not assessed for impairment losses, because every year you adjust its measure and that adjustment takes into account depreciation and impairment losses. So therefore, biological assets on the basis under IAS 41 that you're using what we call the fair value model, and they are fair valued every year. By the fair value model in IAS 41 is conducted every year. It means that you're not depreciating them, you're not assessing them for impairment loss. But PPE, where you are using a revaluation model, and it's not every year, because the revaluation model says you don't have to do it every year, you only have to do it regularly. You see now for PPE, I still depreciate and I still assess for impairment losses. So the student asking, do biological assets depreciate over time? They don't if they are using fair value model. Yes, they will if they are using cost model. But you don't use cost model in IAS 41 until you can't reasonably establish their fair values. So whether they are still growing or they have grown and they are mature, as long as you're using fair value model, you don't depreciate them, you do not assess them for impairment losses. So I hope I've answered that, student. And of course, naturally, if an item is growing, it's actually not depreciating, except the fact that, yes, I can actually be growing, but at the same time, I'm actually getting sick along the way. So please, let's not go into that detail. Yes, examiner will not take you there. But just think that there could be two human beings, and they are both born on the same day, and they are both growing, but one is actually growing while he's actually getting sick along the way. Another one is growing without any sickness. The two of them, when you see them after 10 years, they will not look the same. So leave that for another paper. It's not at your FRA paper. But actually, that's where we say that some of the changes could be due to physical change. The examiner in FRA does not require you to go and compute mathematically that change in fair value due to physical change. So otherwise, if you went back to agriculture, yes, there are some plantations which are growing, but they are not growing like the other plantations in another district, because the weather in the other plantation or climate in the other plantation or the other side is better than this side. But yet they were all the maize seeds were put on the same day. So those differences are physical changes, which your examiner does not go into the details. I hope I've answered that, student. Fair value model by rule don't depreciate under IAS 41 and also under IAS 40, investment properties and also biological assets. They don't depreciate them. They don't assess them for impairment loss. Both IAS 41 and IAS 40, and also another standard called IFRS 9. If you're carrying a financial asset at fair value, you don't assess them for depreciation, because by you doing that every year, you're taking care of all those. I want to kindly request for a short break at this point, except if there are any dying questions. And then we come back and go back to our document. In our document, we're now going to go to IAS 23, borrowing costs, but I'll leave it on the screen so that I come and summarize it and go to another practical question. So I want to propose kindly that you allow me use about 15 minutes to catch up with a snack. I've been teaching since morning. My stomach is really begging. So if you can allow me, just use 15 minutes to catch up quickly with something to eat. Okay, thank you. So 15 minutes, then we come back. Okay, so I'm back and we're good to start, but maybe before we resume, I would want to go through the questions that I'm seeing in the chat. So one is asking, when is it necessary to transfer revaluation gain to retained earnings? I told you that will depend on the company's policy. Some companies can do it every year based on the use of the asset, and that means it's a straight line every year. Other companies can do it on the date they sell off that asset. Either way, they will be transferring it to retained earnings, either systematically every year or the full amount on the date of the disposal of the asset. Another person is saying, come back on how revaluation is taken in retained earnings. I think I've done that for the example we did before break. We actually took it through a debit entry from the revaluation reserve. That means that we reduced it from the revaluation reserve and directly switched it or took it to the retained earnings with a credit entry. So that's how we took it directly from the revaluation reserve to the retained earnings through a direct transfer in the statement of changes in equity. Somebody is asking, can you come again on the note depreciation? Not understood that. On the note, is it not depreciation or not for depreciation? Okay, I've not understood that, not depreciation. Maybe that person, I think that is Jen, you'll need to clarify what you mean by not depreciation. Are you saying not to depreciate or the note for the depreciation? You need to be very clear. So Jen, your question is hanging, except if in the process you saw what I did and understood it, but please come back again. Now, somebody is asking, what does OCI means? Maybe I need to go back. I basically did not want to take a lot of details. Otherwise, OCI means other comprehensive income. Let's just put it there. So OCI, other comprehensive income here in detail, rather than leaving it in pieces. O is other, C is comprehensive, and I is income. Okay. And certainly that's the corridor. We'll take it like a corridor. It's like a room or a corridor, or which we actually use to actually get our transactions or balances go to the statement of changes in equity. So we first put them in that corridor. It's like a waiting room. Let me call it a waiting room. So if you're going to the to the doctor, you're put in a waiting room to wait for the doctor. So the room where you are going to, in this case, is the statement of changes in equity. That's where we are taking our revaluation reserve, but you first hold it, or you first make the person wait in the waiting room until the end of the year to take this person to the doctor's room. So you make the revaluation reserve or revaluation gain, first wait in the other comprehensive income room, and then at the end of the year, you take it to the revaluation reserve. So that's what we use the other comprehensive income for. Another student is saying the 180 million is divided by 8. This 8 is for what? Now, if you remember, we had in the question, if I go back to that question, in that question, we're told that the asset had 10 years. So we're told, let's see, we're told that the asset here, the asset was acquired. Okay, first of all, the asset was acquired on 1st January 2018, and it had 10 years. So mean that by 1st January 2020, of the 10 years, 2 years have gone. So 2018 is when they bought it, January 2018. So January 2019 is 1 year. So January 2020 is another year. So out of the 10 years, we're left with 8 remaining years to depreciate the asset, because we're depreciating the asset over 10 years. Straight line method always takes into account years and residue value. So we are depreciating it over 10 years from the day you bought the machine on 1st January 2018. So by 1st January 2020, when we are revaluing the asset, we shall now be left with 8 years to go, and therefore we shall revalue the asset based on the revalued amount over the remaining 8 years. So that's what 8 meant. So the person who was asking what 8 years or what 8 meant, it meant that we're depreciating that asset over the 8 remaining years. Okay. So then we had another one saying, sir, back on the previous question, it looks like the depreciation expense increased from 20,000 per year to become 22,500. Yes, that's what has happened from January 2020 to December 2020. Our annual depreciation now, based on a revalued amount, has increased by, to 22,500. So that student is correct. And another student says, how does this increase in depreciation? How does this increase in depreciation increase the retained earnings instead of reducing them? So how does the increase in the retained and the increase in the depreciation? Oh yeah, so this student is just confusing to say if it's increase in depreciation, then it's increase in expenses and it's a reduction in profits. No, that's not the case. That one we've done it. If you look at our workings, so go back to that working. There was a working 2 where we actually implied that now our asset is being depreciated at a higher value, 22,500. So the accounting entry there is that you're debiting the profit or loss account, maybe the cost of sales, or maybe any line in there. So that debit of cost of sales implies that you are increasing the cost by 22,500, while the credit is the one that you are using to reduce the asset. Now, in that case, it meant that at that point, when you're accounting for depreciation, it was increased the depreciation with an increase of 2,500. It reduced the profits by 2,500. So now we are coming to the retained earnings to offset that increase in the expenses. So let's assume, let's just put a figure here for that student to understand. Let's assume that before the depreciation in this year ending, in the year ended 31st December 2020. So before depreciation, let's assume that our profits, the profits were maybe 500,000. So those profits were 500,000. Now you depreciated this profits. So we had our annual depreciation, which was increased depreciation. So our depreciation was 22,500. So you took out that 22,500. So it means that your net profits after depreciation is going to be 500,000 minus 22,500. So your net profits is 47,500. But if you had not had a revaluation gain, in this case, I'll have a column to say that without, so this is with the revaluation gain, with a revaluation gain. If I had no revaluation gain, then my normal depreciation, which I call without a revaluation gain, the next column, if I had no revaluation gain, then my depreciation would have been as this. So would have still had 500,000, and my depreciation would be the normal 20,000. So I want that student to hear me carefully. If I had no depreciation, sorry, revaluation, my depreciation would not have been 22,500. It would have been 20,000. The normal annual depreciation, which we had 20,000 every year straight line, would have been 20,000, and it would mean that in that case, our profit after depreciation would have been 480,000. So in this case, it means that your profit is reduced because of the revaluation gain that has increased your depreciation charge. So your profit is less. So your profit, if you see here, it means that your profit is supposed to have been 480,000, but now with 477,500 is less by 2,500. So we'd say that therefore, go to the statement of changes in equity. I'll abbreviate that word, statement of changes in equity. In the statement of changes in equity, I would have my profits there, and those profits which I'm putting in there from the profit or loss account, within the retained earnings. Those profits are under retained earnings. I will be saying that those profits that I've taken are 477,500. I am now increasing them. So what I've done up here is that I've transferred that gain from the revaluation reserve to the retained earnings to increase them. So I'll say increase them. So add back or increase. So we shall say plus that increase or the transferred or the realized, revaluation gain. So that revaluation gain, if I realize it, it will take me back to the figure I wanted to see, and that is the 2,500. If I go back to the statement of changes equity, then I'm saying I'm increasing the retained earnings where the profit is by 2,500. When I increase it by 2,500, it's like the restated profit is now got to go back to the price I wanted. So the restated profit after realizing the revaluation gain is going to go back to 477,500 plus the 2,500. So it will go back to the other figure, which I would have had if I didn't have that revaluation gain. So it has taken me back. So the student who says that I should have decreased, if I want here to say that don't increase the 2,500, instead decrease, then that student is even making it bit worse from 477,500 to even 475, instead of having it increase and take it back to what would be the normal profit without the revaluation. So this transaction to transfer directly within equity, why they call it reclassification, is that you have you initially classified and accounted for the revaluation gain. You are reversing it, you are reclassifying it to say now I'm realizing it. Therefore, whereas it came with bad problems that it increased your depreciation and reduced your profit, it has now been actually reversed or reclassified to take you back to the normal profit. Now, the beauty is that your examiner will not expect you to go through all these details. So here I'm trying to explain to the student, but in accounts, people who work in finance departments basically are able to explain this kind of information to those who are using the financial statements to say, this is the impact of that revaluation gain. The impact is that in the profit or loss, where the profits are, where the depreciation is calculated, it will lead to a reduced profit for the year because of the increased depreciation. But in the statement of equity, it will actually adjust it back through that realized revaluation gain. It will take it back. So it takes it back in the statement of changes in equity, but not through the P&L, because I-16 prohibits you to do it in the P&L. So I-16 says don't reclassify through the P&L, leave the P&L with the figure low, then take it to the statement of changes in equity under retained earnings and increase it again to take it back to the normal figure, as if that revaluation reserve or gain was not there in the year. Okay, so that is that student who's asking whether it should not have decreased. Okay, then there's another one who says, would you please share with us these summaries at the end of this session? Well, yes, but remember, I told you at the start that these summaries, I picked them from your notes. You know, you already have them from the materials which you've gotten from the ICPAL website, and also from your lecturers who are giving you this whatever. It's only that they're details, but me, I'm just summarizing because today I will not teach all standards. I'm just using them as talking points. I'll still share them through the ICPAL contact person. I will send them to you. Okay, but please don't feel squeezed that I don't have those summaries. You have them. You can you have them, though they are details of the book on ICPAL, the book from the tuition provider, the lecturer notes, but those are the ones that I'm using to summarize. Okay, another student is asking, it was a note you make on depreciation and fair value. Okay, maybe this student, this is Jane again. Let me see if I really understand Jane. There was Jane's issue. Can you come again on note depreciation? Then Jane comes down to say it was a note you make on depreciation and fair value. Jane, I'm sorry, I'm not getting you, but are you confirming or you're asking a question? Okay, fine. Maybe she confirms that it was made. So, so I see the next, her next chat says it was made. So sorry. So it's okay, fine. Then another person says, kindly help me to understand why, while calculating annual depreciation ended 31st December 2020 was done on 8 years, while the question they have said the lifetime will also be the same 10 years. So I think I've made that statement, but let me repeat it just for us to read. And just for us to be clear here, maybe I should read very slowly. In the PPE is a machine. This machine was bought on 1st January 2018. This machine was bought at a cost of 200 million francs. And on that day when it was bought, 1st January 2018, this machine had 10 years to live or to be used. Therefore, if each year out of 10 years, when the company uses it, then each year used is knocking off to say, after 1 year, the machine has remaining 9 years. After 1 year, remaining 9 years. So you count it coming downwards until the machine is fully used to 0 and it is no longer of use. So if they bought that machine on 1st January 2018 and it had 10 years to work in that company, by 1st January 2020, after 2 years, how many more years does this machine still have to work for the company? It has 8 remaining years because 2 years have been used in the whole year, January to December 2018, then January to December 2019. So 2 years out of the 10 years that machine is planned to be used in the company have now gone. So it's now left with 8 years to go. So I'm going to depreciate it based on the 8 remaining years to go, but using now the new value, which is the revalued amount of 180. So I'll tell you that some of these questions come out of practice, because I'm very sure that somebody who's asking that has been lectured on that, but because you've not actually gone down to actually do practice on this kind of question, so you actually remember now that where does 8 years come from? So that's what it means. So just a moment. Okay, so back to the question. So I'm hoping the person who asked why 10 years became 8 has understood, because here we are actually depreciating for the year ended December 2020, starting from January. So from January 2020, we have 2 remaining years, because if the asset came to be used for 10 years, 2 years are down. We're now left with only 8 remaining years. And that's why we actually developed our depreciation based on the 8 remaining years. Okay, so then another student is saying, is it true that revaluation is recognized only when the asset is sold? No, it goes by the company's policy. A company can have a policy to realize the gain every year based on the fact that they are actually realizing it by additional use. So everyone I use, let me give an example. If my car, let me say, if the car has actually improved in value and in productivity, then I am happy, because it's now going to take more times goods to the market than it was before. So when I use it more times, I'm actually starting to realize that gain. Again, let me cite that example. If I have revalued my car and it has gone up in value, and because of that going up in value, if I used to take goods to the market 5 times a day, now I'm taking 7 times that day, then I am happy that this car that has appreciated in value and therefore productivity is taking to the market more times than last year, because it's now taking 7 times than 5 times last year. So I am realizing and I'm enjoying that revaluation gain through continued use. When it takes more times than last year, I'm realizing through continued use. So the company can have a policy to say that I will actually realize the revaluation gain every year because it's taking to the market more times. There are companies which will say it's so subjective, I don't see, or I don't know how I can be able to do it every year and it's the same, because it can't be the same every year, and it can't be uniform that I realize it every year. Let me wait until the end of the use of the asset when I sell it off, to say that all that revaluation gain, I'll realize it then, because at that point I will be selling it at a price that is higher than what I would have sold it. So it depends on the company's approach, and they have reasons why. Your examiner will tell you which method to apply. In our case, we've used the case where every year this company is realizing the gain by transferring the revaluation gain from the revaluation reserve to the retained earnings every year, and you saw me doing that. Okay, then somebody is saying share the record. That record is by Iqbal, that's not me. So please, that's ICPAL. ICPAL will do that, I believe, and you'll remind them at the end of the session. And somebody is saying you can share with me. Okay, so this will be for ICPAL. ICPAL will do that. So they want to share that email. Then somebody says, what depreciation method can be used as when you don't give a method to be used? So in that case, everyone, the question does not tell you which depreciation method to use. Please use the straight line method of depreciation. I think I mentioned that. Never assume in the exam to use reducing balance method until the examiner mentions it in the scenario. But when the question does not tell you which depreciation method, always use the straight line method of depreciation. Then another student says, other one, why have you calculated depreciation on revaluation, which was 180,000, and we know that depreciation is calculated on cost? Okay, so that student is asking that now, please, you need to go back to your standard called I-16. The moment you have revalued an asset, then you have started a new chapter of depreciating it based on a new life, and also on more likely on a new useful life basis. If you're using straight line method, please have it stuck with you that everyone you revalue a PPE, then its depreciation is now going to be based on the new value, which is that revalued amount, not the historical cost. So it's like you've done away with the historical cost. You have now started a new chapter of events where you are now depreciating based on the revalued amount. So that's a requirement from the standard. So it's because I-16 says that. So the student was saying, why have you calculated depreciation on revaluation rather than using cost? Is because I-16 says that. And the question we are dealing with is for I-16. So put it somewhere, because you know I-16 will be examined in all your exams. Then another student says, why not impairment and depreciation assessed if fair value method is used? What logic behind? So somebody is asking, why don't we depreciate and also assess impairment? Please remember that this is only for assets that you carry fair value every year. So if every year you are revaluing this asset, then every year, so every December, you're getting the new value of the asset. That new value of the asset compared to the new value of the asset, sorry, to the old value of the asset last year, has taken care of all things that have changed it in the year. Some of the things that change the asset's value is depreciation or impairment losses. So because you've changed it to a new value, you've taken into account all those things that have changed the value, including depreciation and impairment loss. If you do another depreciation and impairment loss, you are double counting. I'm trying to think of any live practical example you can use. So let me assume, let's say that you're talking about a new shirt. If you have a shirt that you bought, a dress you bought last year, and that dress this year or last year you got its value. Its value was maybe 30,000 francs. Then you dress that dress, you wear that dress over the year. At the end of this year, if you want to go back and get its value, and they tell you now it's actually 20,000, it means that to take it from 30,000 to 20,000, the person who has valued it has looked at so many factors. He has looked at the fact that the dress is now old. You've been wearing it for a full year. The dress has now lost fashion. The people in the market don't dress it anymore. So that person has now put it at 20,000. So losing fashion is impairment loss. Your dress becoming old is depreciation. So he has taken all those things into calculation. So if you have done that, and again you say, I want depreciation, which was part of the calculation to get 20,000, or I want even the change in the fashion, which is impairment loss, you are actually double counting. So please, under IAS 41 biological assets or under IAS 40 investment properties, if these are carried at fair value and you're revaluing every year, then that revaluation at the end of the year is taking care of the fact that it has changed in price, it has changed in taste, it has changed in fashion. So everything has been taken into account to get the new value. So therefore, whatever has been taken into account includes depreciation, includes impairment losses, includes all those things that change its value. So that's why we don't have to, again, do another separate one. That after that, here is also depreciation, or here is also impairment losses. So that's the reason. And that logic comes all the way from the accounting standards that demand that fair valuation for those assets are done every year. Somebody is asking, is it possible, sir, if possible, make sure you take us through IS 12. Yes, it's my plan. We're going to go through IS 12 today. especially deferred tax, because I'm sure you'd want to know so much about deferred tax issues. Then another student says, when assets remain zero value and then revalued at certain amount, is the revalued amount depreciated? Remember that the moment you have revalued an asset, then you are using the revalued amount to actually depreciate. The moment that amount is zero, zero, it means that that asset is of no use. Just imagine in your house, if there's something that is of no use, it's broken, it's fully used, that glass is fully broken, you don't even use it anymore. Just take an example of a glass or a plate at home. If the glass or plate is actually fully broken, it's fully depreciated, it's revalued to zero, it's useless. Then you don't even use it to take water, you don't even use it to take food. So you only have wear and depreciation is wear and tear. Wear and tear only comes because you're using it. Now, because it's broken, you're not using it. So there's no need to depreciate an asset whose value is zero. In other words, assets shall never be carried at negative amounts. You don't depreciate it to take it to a negative figure. That is very wrong, accounting wise. So you leave it. Means that that asset is going to even be derecognized from your financial statements. Okay. So, okay, fine. I think we're done with the chat. Let's move on. I'm back to my document, except if somebody had a dying question. I hear somebody is unmuted. If you have a dying question, you ask before I move on. Okay, so IAS 23, borrowing costs. Now here, IAS 23 is basically a standard that deals with those costs that relate to borrowing. If you borrow money from maybe a bank or any loan provider, specifically, at times specifically to buy an asset or to construct an asset, or it may not be specifically that you've borrowed that money to buy an asset or to construct an asset. It could be money coming into a pool. And you're saying that I've borrowed maybe from 5 different banks. When I've borrowed a total of 1 billion, I'll use some money to buy assets. I'll use some money to pay salaries. I'll use some money to repair some assets. So in that case, we shall only pick the money you're using to buy or to construct an asset to capitalize it under IAS 23. So IAS 23 is about those borrowing costs for loans, either that are specifically borrowed to buy or construct an asset, or loans that are general pooled loans from which the company is actually drawing or picking money to buy or to construct an asset. Now, I'll tell you that IAS 23 is not a requirement for qualifying assets that are measured using fair value. For example, if you're buying an asset, if you're borrowing money from the bank to actually buy animals like the cows, which are actually going to have in a well organized activity like a farming activity. So in that case, that will not actually, the principles I'm going to look at here will not actually go for a case where the qualifying asset is that asset that is correct and measured at fair value, or mass produced inventories. So you could actually be borrowing money from a bank, maybe 1 billion, and yes, it's specifically to help you buy goods for resale. And when you're buying these goods from resale, maybe you're buying these goods from maybe Dubai. But these goods or this production, maybe it's even to help you produce goods, let's say, produce goods. And this is a mass production of goods. It's not one specific product or one specific product line, but it's a mass production of goods, and they all have different aspects and all different attributes to how you are measuring them. IAS 23 will not go there. The beauty is that your examiner will not extend that far. So don't get worried on those exceptions or limitations of IAS 23. Your examiner will actually go straight to the second bullet to say that the borrowing cost will include the interest expense you've incurred, which is not be measured. Usually for your examiner, it will be measured on the fixed rate of interest. But ideally, if the fixed rate of interest is different from the effective or market interest rate, we shall always go by the effective market interest rate, which effective rate of interest is picked from IFRS 9. I know that occasionally your examiner can ask or can tell you that you borrowed money from a bank, you borrowed 1 billion francs, and the fixed interest rate was 10%. But the same amount of money has an effective interest rate of maybe 12%, because when you pay back that money, you'll not only pay it back with interest, but there will be a premium on payment of maybe 1.1 billion. You will pay 1.1 billion plus interest every year. So effectively, the interest rate is not just 10%, but 12%. So in that case, we shall use the effective interest rate to compute the finance cost, which I'm going to talk about today, that I need to capitalize it to be part of the initial cost of the asset that you have borrowed money for. In that case, we are looking at finance charges. And those finance charges, if it comes to IFRS 16 leases, we're looking at those finance charges related to the right of use asset. Because in substance, everyone you lease an asset, it's like you're borrowing money to hire that, buy that asset, but it's like on a hire purchase, or it's like a loan, but versus the use of an asset basis. So in that case, under IFRS 16, we shall link IAS 23 to actually say that that qualifying borrowing cost is actually going to be that finance charge that we would actually commit ourselves to in respect of that right of use asset for which you specifically borrowed. Otherwise, it could also extend to exchange differences, especially exchange losses that arise on foreign currency borrowings. So if I borrow money in a foreign currency and I'm meeting not only interest, but also the exchange difference, because maybe you are supposed to pay back that money in dollars every month, and that money you're paying interest is a fixed amount of dollars, but the exchange rate between the francs and the dollar keeps changing. As a result, you are actually meeting an exchange loss. So that exchange loss, due to the fact that you're paying interest at an exchange rate which is different from the rate you used to borrow, is actually going to be part of the borrowing cost that we're going to capitalize. So in this case, this should be relating to a qualifying asset. So you cannot capitalize a borrowing cost as part of the initial measure of an asset, except if that asset is actually qualifying to be a qualifying asset. So IAS 23 is the standard that defines what a qualifying asset purposely for the capitalization of borrowing cost. And a qualifying asset is that asset that takes substantially a long period of time to have it actually ready for the intended use, or to have it actually fully constructed and ready for use or for sale. And in the process of constructing it or purchasing it, you are already meeting or incurring an interest cost on the loan you borrowed. So that actually makes it a qualifying asset. A very good example, assuming that you are buying a car as part of your asset, and you're buying that car from maybe Japan rather than from somebody, a dealer in Rwanda. And from Japan to Rwanda, the car will take maybe 4 months to get there. And yet you've borrowed money from the bank to buy that car, and the money or the borrowing, it requires to have interest per month. So the 4 months that the car is getting prepared or the car is being shipped to Kigali is a 4 months that you're already meeting interest in the bank for the loan. By the time the car comes to you, if the car was 100 million francs and the interest you've paid in 4 months is 10 million francs, then the cost of that car is not only the 100 million francs you paid to the person in Japan, but 100 million plus this extra cost called interest of 10 million. So the initial cost of the car is both the purchase price plus this capitalized borrowing cost, which is 10 million. So it becomes 110 million. And therefore that asset is qualifying to have part of its initial measure, having this borrowed cost capitalized to be part of it. So it becomes a qualifying asset to have the borrowing cost to be capitalized as part of the initial measure. So that's what we mean by a qualifying asset. And in this case, borrowing costs that are directly attributed to those qualifying assets as a requirement in IAS 23 must be capitalized. Otherwise, if they don't actually link to, or they don't actually qualify, they are not part of that qualifying period. By the way, the qualifying period is that period under which you are actually actively seen to be purchasing the asset or constructing the asset to get it ready for the intended use or sale. So that period is the only period, we call it qualifying period, is the only period whose interest is actually going to be capitalized. Otherwise, after that period, if you're still paying interest on this bank loan, that interest is now going to be expensed to the P&L and be placed in a figure, in a line called finance costs. Now, it will be very clear that even before that, there could even be a case where maybe you have this arrangement with the supplier of the car from Japan, that I am waiting for you to get the car come to me in 4 months, or when it gets here, then I'll transfer that 100 million francs to your account. But you borrowed that money 4 months ago, or at the start of the transaction, so that you're sure the money is with you. And each month you're meeting a cost called interest cost with the bank, but you're keeping the money around. So you may decide to invest that money in the 4 months as you wait for the car to get to you. You may invest that money in a short-term fixed deposit facility or fixed deposit arrangement. And in that case, you can also earn interest income on it. So IAS 23 says that the interest expense that shall be capitalized will be the interest you've paid to the bank for the loan of the 4 months minus the interest you've earned from you fixing this money into a fixed deposit account and you've received this money, as long as this interest you've earned does not result into a negative interest expense. In other words, it should never result into negative. The interest income should never exceed the interest expense. If it exceeds, we shall leave it at 0. So the interest expense we shall capitalize is a net figure, which is the interest cost you've incurred on the loan you've borrowed minus any investment income from a temporary investment of that loan that you've maybe put on a fixed deposit account, and that figure should never go below 0. In most cases, it will actually be it will be more than 0. On the basis that if you've paid interest of 10 million over 4 months, more likely the fixed deposit facility could even be with the same bank, could only be earning you maybe 2 million out of the 10. So your net interest cost in that case will be 8 million. 10 minus 2, it will be 8 million, which is the figure you'll capitalize to be part of the initial measure of that asset. Now, there are cases where you may have this interest from a general pool of loans. You borrowed from maybe 5 different banks, and when you borrowed from 5 different banks, you borrowed a total of 1 billion, but you only need 100 million to buy the car. So in that case, if the 5 different banks that lent you money that made a total of 1 billion, each lent you at a different interest rate, then the interest rate we shall use in a general pool shall actually be a weighted average interest rate, not the specific fixed interest rate or not the effective interest rate, but it will be a weighted average interest rate, which I'll actually show you how to go about that through an example that I'm going to look at. Otherwise, in IS 23, that capitalization of an interest cost as part of the initial measure of the asset will only start when you actually actively start buying. When you actually start buying or start procuring that car in Japan. So the day you start, let me give an example. Assume that you borrowed that money from the bank on 1st January 2021. Then you actually issued a local purchase order or an order to the company in Japan to give you the car on 1st February 2021. You remember you borrowed the money on 1st January 2021, but in the month of January, what were you doing? In the month of January, when you got the money, you started looking for who to buy the car from. So you're going through the procurement procedures to actually get the car bought. So in that month, you're not actively getting the car, but you're actually actively looking for just the supplier, but not actually getting the car come to Kigali. So in that case, we shall say the interest of the month January is not going to be capitalized because you're not actually buying the car. You are looking for a supplier for the car. Now, on 1st February, now that you've seen the supplier, and you've given him the local purchase order on 1st January, that's the day you actually start actively looking like you're buying the car by issuing that local purchase order. So that's the day we shall start capitalizing the borrowing cost. Now, we shall capitalize that borrowing cost until there's any temporary suspension in the active procurement of the car. Assuming that in February, you've gotten the local purchase order to the supplier, and the supplier is actually shipping the car, then all of a sudden, when the car is ready to be shipped on 1st March, the supplier tells you that in our country, the government is on holiday, so they are not able to actually do the tax clearance of the car to move on the ship. And it says that for a full month, the whole month of March, then the whole month of March, there's an interruption. Though it's temporarily, there's an interruption in the active getting the car to Kigali. So the month of February, you still be paying the loan in the bank. So that interest on the loan in the month of March will not be capitalized. We shall take it to the P&L because in that month, you are not actively getting the car to Kigali since the government in Japan has suspended the clearance of the cars on the ship, and the ship is still idle there. Now, if then the car starts getting shipped in April, and it's coming to Kigali, and the whole month of April and May, the car is on the ship, then it gets to you in Kigali at the end of April, or let's say May. Then up to that date you receive it, you'll be capitalizing that borrowing cost as part of the initial cost of the car. The day you receive the car, and it's with you, and therefore it's ready for whatever you want it for, then you shall stop to capitalize that borrowing cost. Whether or not you're actually using it for what you wanted it for, or you're not, we shall actually say stop capitalizing the borrowing cost on in respect of the loan that was acquired to buy that car. For example, maybe you've gotten that car at the end of April, 30th of April, but because maybe you're waiting for the chairman of the board to come back to the country to have actually to officially launch or to officially accept or to officially be around when you are actually starting to use the car, and maybe it takes a full month of the whole May, because the chairman of the board is still out of the country, then the interest you're paying for the month of May is not going to be capitalized because that car was ready in April. It was simply your internal decision to say, let me wait for the chairman of the board to come and be the one to first drive it. So that does not necessarily mean it wasn't ready for its intended use. It was ready. It's only that for you, you decided to wait for the chairman. And the reasons why IS-23 says this is because at the end of the day, under the conceptual framework, we would want to ensure comparability of the accounts of this company against another company, which other company says for us, the moment the car is in Kigali, we shall start using it to do the work it came for, not to wait for the chairman of the board. So we want to compare both companies by having the same approach. So we would not go by your internal decisions, which are actually very subjective in that case. So that's where, so in others, IS-23 guides on when do we start to capitalize and when do we stop to capitalize that borrowing cost. In between those dates, is it possible that we may even temporarily suspend capitalizing of the borrowing cost? Yes, like when we had COVID and people were constructing buildings and they borrowed money to construct those buildings, and buildings are assets, the interest they were paying every month in respect of the money they borrowed to construct the buildings, when they suspended constructing buildings because of the COVID lockdown, then all interest that was paid for the months that the country was locked down and were not constructing is interest that cannot be capitalized, because at that point that company was not actively constructing or continuing with the construction of the building since there was the COVID implication. So in that case, we would not capitalize the borrowing cost in that period. Now, I have a question that I picked from a past paper exam, and I'm picking it from the August 2021 exam, and that's question number 3, part A. Sorry, part B. It's also a section A question. So I'm picking it from the August 2020 exam, and I'm picking question number 3, part B. So here's question 3, and then I'm picking it part B. So part B is in there, which says XYZ PLC is a publicly listed company. It has 2 loans. So this company borrowed from 2 sources, even if it's the same bank, but 2 loans in existence in the year. And these loans, so in the same year, it commenced or it started constructing a qualifying asset. So you see the word qualifying asset. So that already tells you that don't even go to check whether the asset is qualifying. But secondly, you see that this is when it commenced. So construction, so that's the time we shall also start to capitalize the borrowing cost. Now we're told that the details of these loans are as follows. So they've given you the details of the loans at the start of the year, January 2019, and at the end of the year, 31st December 2019, in million francs. So they're telling you that there are 2 loans. One loan was I will call it loan 1, was a 12% loan, a 12% bank loan. The second loan was a 9% bank loan, and they're all repayable. So one is repayable in 2021, another one will be repayable in 2022. So loan 1 is a 500 million loan right from January 2019 and December 2019. So that loan remained 500 million, while the second loan remained 750 at the start of the year and also at the end of the year. Now we're told that these 2 loans, or these 2 loan notes, were originally obtained in a general loan pool. So this is why we're going to use the weighted average interest rate, because these are 2 loans. One is 12%, another one is 19%, and you want to actually capitalize the borrowing cost. At what interest rate are you going to capitalize if these are 2 different interest rates? We're going to get the weighted average interest rate. Okay, so back to that statement. The 2 loan notes were originally borrowed or obtained in a general loan pool, but partly applied. So you see, not all the amount of loans were used to construct the qualifying asset. So they drew out or they picked out some of the monies. Otherwise, the other monies maybe could have been used to repair assets or to actually pay salaries or to meet other operational costs. So we shall only restrict our capitalization of the borrowing cost to only the money they've picked from this pool that was used to construct the building. So not all these total loans shall be the basis for our capitalization of the borrowing cost. Is only the money they picked from the general pool of the loan to actually construct the asset that we shall use to capitalize the borrowing cost. So I thought that the construction work began on, so that date is very important. So our construction work started on that date. So that's the date we shall start to capitalize. So even if this loan was borrowed on 1st January 2019, the months of January, February, and March, they were still doing the LPOs. of the people who are going to construct, the construction companies. So those periods, that month, January, February, March, even if we meet interest with the banks, we shall not actually capitalize that borrowing cost because it was not yet, we had not actively started constructing the asset. So that date is very important. They started constructing on 1st April 2019 with the expenditure of 180 million francs. So the money they picked from the general pool to construct on 1st April 2019 was 180 million francs. And they drew another money, or they picked another money amounting to 70 million francs. And this was picked. Okay, so I think there are two dates. So with expenditure of 180 million francs and 70 million francs drawn down or picked from that pool to construct. So this is specifically to help with the construction. So that money was picked from the general pool to help with the construction. And some of that money was picked on 1st April 2019 to help with the construction. And the other money was picked on 1st November 2019. Okay, so in this case, it looks like, therefore, we have two loans. If I go by the dates you picked, it looks like you have two construction activities. You started constructing to some extent April 2019 to maybe the year end December 2019, and those are 9 months. And you picked 180 million, and we shall get the weighted average rate, and say 180 million times that weighted average interest rate times 9 over 12 months, time apportion it, because that weighted average interest rate is deemed to be per annum. We need to time apportion it to say for 9 months, so times 9 over 12. Then you picked another 70 million, which is seemingly like a second construction, though it's still within the same construction. This time around, you picked it on 1st November 2019, and to December 31st, those are 2 months, November and December. Again, we shall say the same weighted average interest rate, this time around, times 70 million, but this time around, time apportion it to 2 months, November and December. So that's the statement respectively. So 180 million was drawn on 1st April, or picked in 1st April 2019 to help with the construction, and another 70 million was picked on 1st November to help with another construction, even if it's the same building. And this was from the existing loan. So construction works were completed. So that word completed, we shall cease. So remember that you stop capitalizing capitalizing borrowing costs the moment that asset is ready for its use. In other words, the day you complete construction. So we shall start to capitalize for construction element 1 from April 19 to December when they stopped constructing or construction. Then for the second element of the borrowing, which is 70 million, we shall start capitalizing from 1st November to 31st December when they completed construction. So the question here is explain. So this time around, I also have to explain. So I have to narrate. So go by the instruction and quantify. So 2 things I have to do in this question. I have to explain the principles of IAS 23 and apply them to the information in the scenario. But while I do that, I need to be calculating or quantifying how the borrowing costs on the loans and the qualifying asset shall be accounted for by this company XYZ Limited for the year ended December 2019 in accordance with that standard IAS 23. So let me go to my Word document because I need to do some explanation. I can actually put it down there to say that I'm looking at the explanation. But my explanation is going to be supported with also the quantification. So I would be better off to quote IAS 23 first, to say that under or in accordance with IAS 23, in accordance with IAS 23, where a borrowing cost relates to a qualifying asset, then this is capitalized as part of the initial measure of the assets. So this will earn your mark. So that statement will earn your mark. You've actually talked about the standard. So in this case, you're starting to explain different from the information that was in the scenario, trying to explain or trying to educate whoever is actually reading this information. And this is actually picked from the accounting standard, and that statement will earn you actually a tick and therefore a mark. You may even go ahead to say where a qualifying asset, you could even say where a qualifying asset is that asset that takes substantially a long period of time to get it ready for its intended use or sale. Okay, so there you are. Now you go on to say that where the borrowing is by, where the borrowing is through a general pool, the interest cost used shall be the weighted average interest rate. The weighted average interest rate. And here, this is also going to earn you a mark, and you want to apply it to say that therefore, in the case of XYZ Limited, in the case of XYZ Limited, the weighted average interest rate for the general pool, borrowing shall be calculated as, shall be computed as, and this is where you are quantifying or you are computing. So you are going to get the big figure. In this case, we shall say, if I go back to the question, we're told that we had two loans. One loan was a 12% bank loan amounting to 500 million, and the other loan was a 9% loan amounting to 750. So this is what we shall do. We shall come back here to say that this is going to be computed. I can put it down here. I'm looking for a better, okay, I think I can use that. So I'll say that I'm looking at the first loan, which was 12%. Was it 12%? Again, just double check. The first loan was the loan of 12%, and the amount of that loan was 500 million. Okay, so in this case, I'll say 12% times, I will prorate it. So to get the weighted average, I'll prorate it to say that I'm looking at 12 million out of the loan of 500, but divide by the total pool of the loan. So the total pool of the loan is 500 plus 750, which is 1250. Okay, then plus the second loan is the loan whose rate is 9%, but that second loan is a loan of 750 million out of, or in proportion to, the total amount of the two loans, which is 1250. So this should actually be able to give me the figure I'm looking for. So let's start with the 12%, and I can use my Excel because I don't have a calculator in front of me here. So somebody can help me to say that if I are looking at 12%, and I'm looking at 12% of the 500 divided by 1250. So in this case, I would say 12% times that fraction. So if I put that into percentage, that percentage is going to be something like 4.8. Then the second loan is the one that is 9%. But that 9%, we are actually basing it on a loan, which is 750 out of the total loan, the total pool of loans of 1250. So I mean that I'm looking at the 9% times 9% times the 0.6. So I have something like 0 point, sort of in percentage, something like 5.4. So I'll add these two figures. So I mean that if I come back here, 4.8 and 5.4. So it's like I'm saying 4.8% plus 5.4%. So this should be able to give me the average interest rate to use. So mathematically, if I went back to my Excel, that is 4.8 plus 5.4 gives me 10.2%. So the weighted average loan rate or interest rate I'm using is 10.2%. And this is 10.2% per annum. A year per annum. So if you did this, maybe I could even pull it here. If you did this to the examiner, you are actually earning yourself more than 1 mark. First of all, you've earned yourself, oh yeah, here is calculation. So you're earning yourself that point based on the fact that you've calculated it. Okay. Then after that, you come to apply it to say that therefore, that under IS 23, the capitalized borrowing cost, under IS 23, the capitalized borrowing cost or the money to, sorry, the borrowing cost to capitalize shall in a general pool, shall be restricted to only that amount of the borrowing that has been drawn out, drawn out of the pool to fund the construction, sorry, the capitalization through, in this case, through the construction of the asset. In this case, through the construction of the asset. So here, you've talked about that accounting principle that gives you that mark in that case. Then you come and say that therefore, XYZ Limited, and that's why I'll tell you each point start it on its own. So XYZ shall, and you can say, and this will be time apportioned, maybe, and this is time apportioned where applicable or where necessary. So because we're going to time apportion it somewhere. Then you come and say that XYZ Limited shall therefore capitalize borrowing costs for only the amounts of the loan, used to fund the construction that include the 180 million plus the 70 million. So that is 250 million francs. So that is the 250 million. Is it 250? Yeah, 250 million francs out of the total loan pool of 1,250 million. 1,250 million. So recall that that's the total pool of the loans. So we shall only capitalize for the amounts that we've drawn from the loan pool for the capitalization, and that will actually, that statement, make the examiner earns you a mark for that statement. Then you start computing it, and you say, and this will be time apportioned. This will be time apportioned appropriately. So if you're doing that, then you come to start to say that therefore that the first loan acquired, so the first loan amount used on 1st April 2019 shall result into a capitalized borrowing cost, of, again, compute it. So in this case, recall that you're using this average interest rate, this figure here, the 10.2%. So here you are calculating it to say 10.2% times the money that you borrowed. That amount was the 180 million francs, but time apportioned. So this is 180 million times the 9 months, 9 over 12 months. That is from April to December. So mathematically, I don't have my calculator, so I'll go to my Excel to say that in this case, that is actually looking at 180 million times the 10.2%, that rate, then times the 9 over 12 months. So that gives me a borrowing interest rate of 13.777 million francs, that figure there. So I've time apportioned it. I'll get the 180 million times the 10.2% times the 9 months from April to December. When that asset was actually completed. And I should even have, I'll go back to refine that statement, which I should have made ahead. I'll go back there, but here I know I have 13.77 million francs. So this is 13.77 million francs, okay? Then that will earn you a mark for having stated that. Then you'll also say, and the second loan, the second amount of the drawn out loan shall result into a capitalized borrowing cost of, again, we'll do that. Remember, it was 70 million this time around. So this is 70 million times the 10.2%, that is our weighted average interest rate. Then times this time around, it's actually going to be 2 months. Maybe at this point, you would even have said drawn out, drawn out on 1st November 2019 shall result into a capitalized borrowing rate of this amount. So this is in terms of months. So I'll go back to my Excel and do my calculation to say that now this other one will be the 70 million times, again, that weighted average interest rate, this time around times 2 out of 12 months. So I'll have 1.19. So here I'll have my 1.19 million francs. So this gives me 1.19 million francs. Then I'll say that in total, and this again earns you a mark. Then I say in total, the borrowing costs, in total, the borrowing costs to capitalize, in total, the borrowing costs to be capitalized as part of the initial measure of the asset is, then you combine. You remember you had a 13.77, so you now have a 13.77 million plus the 1.19 million. So in total, if I add it again in my Excel, that in total would give me a total of 14.96 million francs. So this gives me a 14.96 million francs. So 14.96 million francs. And that earns you another mark. But in the process, you should even have made a statement here to say that, so here you should have said that somewhere here, it can be anywhere, you can say that the under IAS 23, under IAS 23, the borrowing cost is only, commences to be capitalized from the debt. The entity or the company commences to actively engage in the capitalization of the asset. That is to say, for example, starts to construct, the debt commences to construct the asset, constructs the asset, and ceases or stops when the asset is ready for its intended use. So that statement will earn you a mark. And you may want to earn another to say that XYZ Limited shall cease to capitalize the borrowing costs. When the construction of the asset is completed. When the construction of the asset is complete, which in the case given is on 31st December 2019. So that statement is another statement giving you a mark. So I'll tell you, if you looked at the question itself, just check the question. That question itself gave a total of 15 marks. So some of those marks were actually the calculation marks. So the calculation marks on their own also had their own marks in there. Remember that we needed to calculate the weighted number for each, and the statement is a mark, but each calculation was a mark on its own. So at the end of it all, you're actually making or working out of those 15 marks. So that's how you are answering the question. So just check how you're dealing with this borrowing cost. If you see what you're doing here with the borrowing cost. So you have this statement that has earned your mark, and you have another statement here that earns your mark that you disqualify. You've defined what the qualifying asset is. So that's actually earning your mark. Then you've gone on to look at the case of a general pool where you have to capitalize so to get the weighted average figure in there. And this statement alone is earning your mark, but in there you have a mark for each of these figures. So this figure alone earns your mark. This figure there earns your mark, just like also that figure there earns your mark. So that calculated figure alone earns your mark. So each of those that makes up that total combination is actually earning you a mark. And also the fact that you're saying that this should be time apportioned where applicable should actually earn you a mark on its own. At the end of the day, the examiner is allocating those 15 marks in respect of the principal, but also where applicable, you're relating it to the real case in the scenario, XYZ limited, rather than going by rote learning, prom work. So here we're not doing prom work, we've specialized our answer to the content given to us in the scenario. So that's IS 23. You realize that IS 23 has a lot to do with assets, especially PPE, IS 16, that initial measure. And I must have mentioned it when I was dealing with PPE, that initially that cost will also have an addition called borrowing cost, where that's applicable in accordance with IAS 23. Okay, so I think, let me, before I go to another standard, let me see if there's any question coming in here. Could you allow us to see the questions being asked? Oh, I think I did. Were you not able? I hope you are able to see everyone. I went to the question itself. Oh, you're asking for the chat. Sorry. I don't know how I can do that technology, but I thought these questions are for everyone. Maybe they're for only me. So I'm reading them out loudly the way they are being asked. I think she's asking the questions from the chat. Okay, so somebody is asking, you always use the finance cost while doing capitalization? The answer is yes, it's the interest rate. I think that's how I've gotten the question anyway. So somebody is saying, what happened when we borrow from different banks, but for construction of qualifying asset, do we need to calculate average rate? I've done that in the question. This question, we've gotten the average rate as 10.2%, even when the different banks you've borrowed from, one gave you at 12% and another one gave you at 9%. For us, we've gone with the average borrowing rate of 10.2%. So that, student, I think I've answered you. Then the other question is when the temporary income is calculated. When is the temporary income calculated? It's calculated only when this company invests that money on an account that earns it a return. So if the question does not mention that, you don't have to calculate it. If this question had told us that in the process when this company was constructing the building, especially that month of November, and yet they borrowed it on 1st January 2019, if this company had invested it in a fixed deposit account and they gave you the amount, how much they received as interest income, then would take it off. So just for me to tell you, if out of the borrowing cost that we are capitalizing, because in total, our borrowing cost we're capitalizing is 14 point something, 14.96. If they told you that in the process, in the period of the direct construction, it should be only that period of active construction. If this company had invested these monies and earned a return of 2 million, then our borrowing cost will be 14 million, 14.96 minus 2 million. Either the examiner will give you exactly how much was received in the temporary investment of that money, say 2 million, or the examiner will give you the rate of the investment rate of return, to say that all that money was invested. You can even pick maybe the 70 million, to say the 70 million was initially invested and earned a rate of return of maybe 2% in the months up to when it was actually taken away or taken back to be used in the construction in November. So in the period when you're actively capitalizing the asset from April and until November, if that money, the 70 million, which was not being needed then, you invested it in a fixed deposit at a rate of 2%, then we shall say 2% times 70 million times the number of months between April and November. Maybe let's assume that those are 8 months. So times 8 over 12, because that 2% would have been a full year's percentage. So that amount is the one that would calculate and take it off from the 14.96 to say that the borrowing cost we capitalize is net of or is minus the investment income. So please, all you need to know, remember I told you at the start that the exam questions are original. Don't expect the question that we have here to be the same every day or every sitting. The examiner is thinking of another original version, but all he needs from you is to know the principles. If I know the principle that my interest cost that I capitalize should be based on the figure after reducing it with the investment income, and I know investment income is only that income in the active period of construction up to when you are ceasing to construct, then or up to when you are using that money, recouping it back for further use in the construction, then I know whichever version of the question the examiner puts, I'll know how to calculate it. So all you need by the exam day is to know the principles and wait for the original version of the exam question and just be happy to answer it. Okay, so I think I'm now set to go to the next topic. Somebody says we capitalize 250. What about interest for remaining loan? So that remaining loan, remember I told you that this is a general pool of loan. Maybe they've borrowed money to pay salaries, to make repair, to pay for repairs, to pay for maintenance. So those are not going to be capitalized. We only pick the money you've used to capitalize, so to buy or to construct an asset, and that's the one we shall capitalize a borrowing cost for. Somebody had a comment?
Elijah.
Okay, so I'll need all of you to mute. I don't know how I can do it. Maybe I can mute myself, the people who are talking. If you're not, please just to request you kindly, if you're not making a comment, please don't unmute. But somebody has put a hand up. I don't know whether it's now or sometime back. It's somebody called Dawi. If you can ask the question, maybe now, maybe I could open it up for people who have questions, because this is one of those standards that is sensitive, IS 23. So let me start with, oh, the hands are down now. I wanted to start with Impuwezawe. I hope I'm mentioning it well. If you have a question, please ask. I'm giving you that time, because I've seen your hand up. Okay, she's not asking. He or she's not asking. How about the one that has user? Okay, people, you're putting your hands up. You're giving me the impression that you want to speak. So I'm asking you to speak. Okay, if you're not speaking, then, or anybody who has a question, please ask. This is your time to ask. Okay, so I'm moving on, since I'm not hearing from you. The other standard that is crucial in your paper is IAS 20, which is actually looking at specifically its government grants, but it's actually titled Accounting for Government Grants and Disclosure of Government Assistance. Now, this standard applies to all government grants, but not those grants that companies receive in respect of funding or supporting them to finance their agricultural activities under IS 41. And that is because IS 41 deals with the grants on its own side. Please don't worry, your examiner will not take you to that extent, but the standard demands that please never include grants that are specifically received to support or to fund farming or agriculture activities, because those are under IS 41. Otherwise, these grants can come in all forms of government assistance. They could even come as grants related to assets or grants that are related to income, but they should exclude any tax benefits that a government of the country gives you. If a government of the country says that as a new investor from a foreign country, I'm giving you a tax waiver, in the first 2 years, you'll not actually pay taxes. That is not a government grant under IAS 20. Please, I would want you to go with a lot of confidence to tell your bosses or any person that is of high authority to say that any grant we received from the government through a tax reduction or a tax waiver is not a government grant accounted for in accordance with IAS 20. Otherwise, these grants are only going to be recognized. Those grants you take as government grants under S20 are only going to be put in the financial statements of a company if two conditions are all satisfied. So the day you have satisfied the conditions coming with the grant, because those grants come with conditions, or the day you are sure that you will satisfy those conditions is the day you are going to recognize that government grant, as long as that grant has either been received, so it's on your bank account, or it is receivable, meaning that you've received the letter from the donor or the grantor that, yes, I confirm, I'll actually give you this kind of grant. That's the day we shall say debit and credit. If you've received it, debit cash and bank. If you've not received it, debit receivable. If you have debited bank or receivable, the corresponding credit will depend on your accounting policy, and that's where IAS 20 comes in. IAS 20 comes to deal with the credit entry. Should that credit entry be taken to the balance sheet as a deferred income because you're using a deferred income approach, or should it go directly to the P&L to actually address or to reduce the expense the grant has come to actually help you with? Maybe it's a grant related to income to help you address or to help you pay off your salaries. Then should we go and credit that expense to reduce it by the amount of the grant? Again, that will be depending on whether you've received the grant and satisfied the conditions immediately, or you have a policy to say that if that money coming to help you with salaries is for a period of 5 years, then I'll not actually go and reduce it from the expense itself. I'll first hold it as a deferred income in the balance sheet using the deferred income approach. Otherwise, in the principle of IAS 20, always match that amount called grant with the expense to which it relates. If that grant comes to help you with salaries, maybe for that very month, then match that grant with the expense. So it comes in your P&L as income, matched with the expense, which is the salary expense to which it relates, so that we have a matching concept. It offsets or reduces that expense by the amount of the grant. But you should never take it to negative. The beauty is your examiner will not do that. But let me tell you, practically out there, it can happen. I could have paid salaries of 100 million francs, and the person who's supporting me with those funds, with those salaries, who in this case is the grant, is actually giving me in a foreign currency and is giving me in dollars. When I translate that money, it's not 100 million, it's maybe 110 million. That 10 million that is extra is not actually going to reduce my expense called salary expense, because my salary expense should not be negative. In the first place, when I paid the salaries, I debited the salary expense account with 100 million. When I received the grant in that very month, I should credit that expense with 100 million so that it's zero. The extra 10 million, because of the exchange difference or exchange gain, shall be classified and presented as gains from exchange differences, which we call an exchange gain. It's not a reduction of the salary expense, and that's part of your other income. Please, your examiner will not do that, but practically out there, companies, it happens. Otherwise, if this grant has been received to help me finance or buy or purchase an asset, and I have received that money and the asset I've bought is 100 million, and I'll use this asset for 10 years, and the person who's helping me with this asset, so with the grant, has given me maybe 40 million to help me partly support me with buying that asset. It means that because that asset is not in the P&L, it's in the balance sheet. Yet I want that rule to say I should match the income called grant with the expense to which it relates. Then I'll wait until that asset impacts on the profit or loss through an expense called depreciation expense or charge. When it's depreciated over 10 years, 100 million divided by 10 is that every year there's a depreciation of 10 million. Then I'll also be taking to the P&L a grant income of 40 million, because I received the grant as 40 million, divided by 10 years. So in that case, when my depreciation expense is 10 million, my grant income every year is 40 million divided by 10 is 4 million. So it's matched with that expense, because that asset has impacted on the P&L through a depreciation expense, which I'm now offsetting or reducing by the amount of the grant that relates to that period. So that rule is very important. And I want to tell you that that is the running principle that impacts on the accounting for government grants. Otherwise, a grant for costs that have already been incurred, like you've already paid the salaries, or where there's no future related cost to still incur, is a grant that we shall assume its conditions have been fully satisfied, and therefore we shall fully recognize that grant on receiving it in the P&L. So if that grant comes for expenses, salaries you've already paid, the whole grant take it to the P&L, because even the conditions to it have been satisfied, that employ this number of females in the job, in the work, or employ this caliber of people, the disabled people. So those could be the conditions. Now, where we have non-monetary grants, there are cases where the company can get a grant which is not monetary value, which is not a monetary grant. They get physically a car or land or a building. So the grantor gives them that building or that land or that car. These are usually accounted for at their fair value. So you shall get the fair value of that car on the dates given to you. So in that case, it will be linked to other standards. If that grant, like usually it's linked to a standard like I-38 intangible assets, usually you'll get a case where the government says that I'll grant you a license to operate your radio station in the rural area, in the village, where those companies, private radio stations don't want to go there because they will not make money there through adverts. So you can take your license, you can take your radio station in the village, and I'll give you a license, grant you a license as a government for 10 years, free of charge. So that's a grant related to an asset coming in form of a license. In that case, on the day the government gives you that license to operate the radio station, and the license is an asset called an intangible asset, we shall get the fair value of that license on that date. The fair value is the price you would pay to buy or purchase or to acquire the license from the government. And that would be our debit entry in the balance sheet. Debit the license, intangible asset, based on the price you would have paid to buy the license, then credit the grant income and the deferred income in the liabilities as that amount, which you will release in the P&L, because that license is a 10-year license. Every year you'll amortize it or depreciate it by taking it to the P&L. When you take that license, 10 million divided by 10 years, which is 1 million, again, you'll also go to the deferred income and release the grant, government grant you put in there to the P&L over the 10 years on a straight line basis. So it will go to the incomes as 1 million, match with the expense called the license amortization of 1 million, and it will nail it off, or it will offset it. In a way, you are matching the expense, related expense, with the grant income. Now, an asset-related grant may either be presented as deferred income, and that's what normally examiners want, that the method or the policy of the company is to recognize the grant, the asset granted, the grant related to an asset using the deferred income method, or in very rare cases, it can actually be used, it can actually be carried as a reduction directly from the carrying amount of that asset, which we call the reduced basis method. This is not very common or regular in the exam. In the exam, usually we shall see the deferred income method. Otherwise, all other grants may be reported separately in the financial statements or can be put up in the other income. So in the P&L, when you start releasing the grants, or those grants and recognizing them to the P&L, you can have them stand alone on their individual line capacity if they are that quantitative or they are significant. Otherwise, you can have them summed up in that line called other incomes. Or you can have them deducted from the related expense. You reduce the salary expense by the amount of the grant related to the funding of the employee salaries. Others, a grant which becomes repayable if, because you've not satisfied the conditions of the grant and the grantor says refund back the money. So in that case, that refund, that grant related to income, so that repayment of the grant will have two accounting standards in which it will fall. At that point, it's an estimate because you're not even very sure how much the donor or the grantor will want you to refund back. So IS8 will call it a change in an accounting estimate. So you don't go back to the prior years to say, last year when I recognized it as a grant, when I was sure I will satisfy the conditions, I was wrong. Let me go and adjust with a prior adjustment. No, last year you were very sure you will satisfy the conditions. You have failed to satisfy the conditions in this year, and this is when you are now making that adjustment. But secondly, it also satisfies the requirements of I-37. You now make a provision of that refund in accordance with I-37 as if or like a provision for liability. Okay, so otherwise, assistance which cannot reasonably be measured or distinguished from normal trading transactions should never be included in government grants. So if that assistance you're getting from any well-wisher is not or cannot reasonably be measured, if you can't measure how much it is in monetary value, or you cannot separate it from your normal activities, it's like actually it's a purchase, a buy. So if the reason why your company is existing is to sell sugar, and this company, maybe this donor or grantor comes to say, I'll buy 1 million bags of sugar from you every year. That is not a government grant, that's a normal trading. It's actually earning you revenue. So you don't say that because that company or that buyer has come in a special way to say for him, he has confirmed or committed he will be buying 1 million bags of sugar from me, then I have gotten a grant from him. No, that is not a grant. So that's separate and that's excluded from the definition of a grant. Now I'll tell you that just like other standards, there are disclosure requirements when it comes to government grants. At times, your examiner may ask for the key disclosure requirements that must go with the government grant assistance or government grant accounting that you've done. When that's the case, then you are saying that one of the methods to, one of the disclosures to make is to disclose the method you've used to present the government grant. Either you've presented it using deferred income method or reduced basis method. You should also disclose the grants that you've recognized, including those conditions that you've not yet satisfied and any contingencies that may emerge from the possibility that you may have to refund back that money, or even the different types of assistance that you could have received directly or indirectly from whoever is granting you. But for presentation, it also means that the moment you've used the deferred income method, that grant is taken and presented within the liabilities. Within the liabilities, it should be separated out. A part of that grant should be presented within the non-current liabilities and another part in the current liabilities, and the amount put in the current liabilities should be linked to or related to the amount of the grant that you actually are sure will be realized in the next 1 year from now. Otherwise, the amount of the grant that will not be realizable in the next 1 year from the reporting date is the amount that shall be taken in the non-current liabilities. So I realize that we've run out of time. I think 7 minutes
Bruce,
beyond time.
Bruce, can you hear me?
Yes, I can hear you.
Can you hear me, Bruce?
I hear you.
I think we already ran out of time, and after this session, there is another paper, advanced taxation, and there are some of the candidates who combine the two papers. So I think that will be another session. I think you can, yeah, you can call it a day, and then you will resume next weekend.
Okay, fine. So just to say thank you for the time we've spent today together, and let's wait until next week, but please don't go to sleep. Please actively go to put in action the principles that I've talked about. Practice over time is the beauty of your day. If you can go through the past papers, especially with the standards we've looked at today, then it should actually make you smarter and ready for an exam, especially considering that I've picked the standards that are regular in your exam. I'm yet to pick standards like talking about deferred tax or standards on financial instruments or standards on consolidation, which is what will be my target next time we meet. So thank you very much, and let's meet again.
Yeah, thank you, Bruce, for your contribution. Thank you for your time, and thank you for those who managed to join this session. So just to say thank you without taking much time. See you next weekend, and enjoy the rest of your weekend.
Okay, bye-bye.
Bye-bye.